want to welcome everybody in the audience today and those who are watching via the telecast. If you could call the order. Call the roll call, please.
Absolutely. Controller Yi.
Here.
For the State Superintendent of Public Instruction, Mr. Johnson.
Here.
Ms. Yamamoto.
Here.
Mr. Tang.
Here.
Ms. Hendricks.
Here.
Mr. Keeley.
Here.
Ms. Bradford.
Here.
Mr. Gunning.
Here.
For the State Treasurer, Mr. Rafino.
Present.
And for the Director of Finance, Ms. Miller.
Here.
Chairperson Prezant.
Lack of controller.
That promotion.
And Chairperson, if it's okay with you, I'll proceed now with reading a preliminary
Yes,
note.
please.
The CalSTRS board meetings are live, web streamed, and video archived, and available to the public on calstrs.com. Individuals who wish to address the board should wait for the 10-minute public comment period at the end of the agenda item the speaker wishes to address. For comments not pertaining to a specific agenda item, there will be an opportunity for additional statements at the end of the open session. Each speaker is allowed a maximum of 3 minutes to comment. However, if there is not enough time for each speaker to have 3 minutes, the timing will be at the discretion of the chair. To protect the privacy of speakers under the age of 18 who wish to address the board, only their first name and affiliated organization may be provided, but other personal identifying information, such as their last name, age, or school, may not be shared. Since the July Teachers Retirement Board meeting, CalSTRS received 2 form emails requesting CalSTRS to divest from Enbridge, 2 communications from members regarding divesting from fossil fuels, 10 handwritten emails regarding divesting from various areas, and 6 communications regarding climate shareholder proposals. That's all I have, Chairperson.
Thank you. Okay, the next item on the agenda is item number 2. Oh, yes, approval of the agenda, excuse me. May we have a motion to approve the agenda?
So moved.
Second. All in favor, say aye. Aye. Adopted. Okay, item number 2. 1 goes before 2, Bill. And item number 2 is statement of the public, statements from the public. Do we have any people that want to make a public statement in the audience?
We do have a few members of the public for public comment. So our first speaker will be Genevieve.
Hello, my name is. You want to go to the microphone? That way we can hear you better. Okay. Hello, my name is Genevieve Porter. I'm a student at UC Berkeley studying environmental science. I just spent the past summer studying the CalPERS annual investment reports, and I'm now using that data to advise the CalSTRS Investment Committee for divestment from fossil fuels. I focused mainly on Chevron and Phillips 66 between the years of 2015 and 2021. CalSTRS needs to quit playing around with the teachers' pensions funds and divest from fossil fuels, because what I found on my research with Phillips 66 and Chevron, the calculated percent gains have dropped dramatically since 2015 to 2021. I found that Chevron has cost California $226 million in their dropping investments. I don't know about you, but this does not look like a company that I would want to invest in, especially with our teachers that are on the line. Not only are these companies doing poorly in the market, but since 2000, Phillips 66 has paid $725 million in fines and settlements. Chevron has paid $1.1 billion. Financial arguments aside, Phillips and Chevron are the 20th and 21st largest polluters of carbon dioxide in the United States. California needs to divest from these companies because they're losing even more money in employee sick leave, repairing the roads because of acid rain, and mitigating the forest fires as a result of climate change. This money that has been lost will not return. And luckily, the The return has gone up just a little bit as a result of the lockdowns being lifted and the recent Ukraine crisis. So if we are going to divest, now is the time before we lose even more money. Thank you.
Thank you for your comment. Our next speaker will be CJ.
Howdy. My name is CJ Kep. I work for Fossil Free California. This is my first time attending one of these meetings in person, but I have live streamed quite a few, so forgive me if I'm a little starstruck meeting you all face to face for the first time. I'd like to shake things up a little bit and thank you all for investing in fossil fuels, because if you didn't, I would be out of a job, and I really like having health insurance. I wish I could say that I'm a big fan of your work, but if that were true, I would not be here today. Instead, I wanted to talk about how CalSTRS will be impacted by the Inflation Reduction Act that was passed into law earlier this month. 3 separate analyses have shown that this legislation will soon make clean energy cheaper than fossil fuels, meaning that global demand for oil, gas, and coal will soon crash. As someone who breathes air, drinks water, and has to survive the next few decades, this is pretty exciting news for me. I imagine that this is less exciting for the board of a pension fund that still has $15.7 billion invested in fossil fuels. I'm far from a financial expert, so I don't expect you to listen to me. However, BlackRock, the world's largest investment house, analyzed hundreds of divested funds last year and found that every single one reported neutral to positive financial results. That same report found that fossil fuel stocks have consistently underperformed the broader market over the past 5 years, and warned that even the slowest plans to transition to renewable energy are projected to leave $1 to $4 trillion behind in unburned fossil fuels and stranded infrastructure for those who refuse to divest. Knowing this, it's pretty buck wild that you continue to invest billions of retirement savings of millions of public school teachers into a dying industry. But I understand where you're coming from. When I was in high school, I was also in a toxic relationship. Despite my ex's problematic history and a complete lack of any evidence that he wanted to change his behavior for the better, or that he was even capable of doing so, I believe that if I invested enough time and energy into him, I could fix him, because that's the story that he was telling me. You have been similarly swept into a beautiful narrative composed by some of the best advertisers, tricksters, and linguistic magicians of our time. Oil, gas, and coal corporations have promised you that they will change, that they will get better, if and only if you continue to support them. But if I've learned one thing from years of therapy and an analysis I recently did on CalSTRS' failed shareholder engagement efforts, you can check it out at fossilfreeca.org, it's that you can't stay in a relationship because of the potential that you think you see in someone. Or in your case, the multi-trillion-dollar industry single-handedly responsible for an upcoming mass extinction event. So as a climate activist, a young person, and a human being, I'm telling you that now is the time to divest from fossil fuels before it's too late. Thank you.
Thank you for your comment. Our next public commenter will be Ilanka.
Good morning, members of the Investment Committee. My name is Ilanka Slatar, and I'm volunteer president of 350 Sacramento, an organization that represents over 2,000 Sacramentans concerned about the climate crisis. I'm also here today as a human, as an immigrant who came to this country for opportunities. And I'm saddened to say that the beach where I grew up in Chile in South America is one of the most threatened by sea level rise. And I fear that the places that I grew up are going to be swept away by climate change. Also, as a young person, I have struggled for decades of whether or not I should bring a child into this world, because I'm so concerned that the world that we are leaving behind for them is going to be unlivable. Controller Yi has told us in the past that the only way that we can make change is by staying in these companies and taking shareholder action. And yet we continue to see CalSTRS and CalPERS vote against climate policies in the companies that they are investing in. I don't understand how you all can sit here and say, we can only make change if we stay in here, when we know that these companies cannot be trusted. They continue to put out statements, they continue to make policies about how they're going to reach carbon neutrality or whatever, and we know they just continue to not do that. I ask you, as a CalPERS member, as a former public employee who spent years of my life trying to make change, to take this seriously. You're playing with people's lives. Thank you.
Thank you for your comment. Our next speaker will be Alyssa.
Good morning, Chair and members of the committee. My name is Alyssa Giacchino. I'm with the Private Equity Stakeholder Project, a nonprofit focused on the impacts of private equity and other private funds investments on people and the planet. In 2017, CalSTRS made a $500 million commitment in Blackstone Core Equity Partners, a private equity fund that owns ServPro, which is a disaster recovery and restoration company with a track record of high-risk practices that may jeopardize long-term value. Climate-related disasters are increasing both frequency and impact, destroying schools, homes, hospitals, communities. Yet the people we depend on to prepare for and help rebuild our communities after disasters are largely unrecognized and mistreated even as their work becomes more urgent. Workers employed by ServPro franchisees and their subcontractors clean up and rebuild after fires, hurricanes, and other disasters. They've reported a range of serious issues such as wage theft, dangerous and even deadly working conditions, no worker compensation or disability coverage if injured, and lack of health insurance. This may create workforce, litigation, regulatory, and reputational risks. The problems at ServPro and the disaster relief industry have been highlighted in a number of recent news pieces. An article in The New Yorker last fall noted that, quote, climate disasters require a labor force that is open to arduous work and instantly mobile. ServPro promises to furnish workers to crises sites within days or even hours. One of its slogans is faster to any disaster. To marshal this force, many companies turn to an ill-regulated group of subcontractors and labor brokers, which in turn cultivate social networks of migrants and other people seeking economic opportunity. With the increase in climate-induced disasters, so too there has been an increase in the money spent to help communities recover. The billions of dollars pouring into disaster restoration projects has made it a very lucrative industry and attractive to private equity companies. In the past 5 years, private equity firms like Blackstone have acquired dozens of disaster restoration companies. Resilience Force is a national initiative to improve Americans' response to disasters by bringing together all stakeholders. In February, Resilience Force announced a breakthrough agreement with Signal Restoration, one of the largest emergency response and property disaster restoration contractors on the continent, and a peer of Blackstone's ServPro. Signal committed to a set of labor protection standards that will ensure a more efficient and reliable approach to disaster response, recovery, and rebuilding. The standards will cover workers employed directly by Signal, as well as those employed by any of Signal Restoration's subcontractors. We first reached out to Blackstone about this issue back in March. They have not responded. ServPro did respond, but refused to take responsibility for the working conditions of ServPro workers. The Blackstone Group should join Signal Restoration in this effort to dramatically improve the resilience worker industry and ensure a more effective approach to disaster preparation, response, recovery, and rebuilding. We believe CalSTRS should ask Blackstone how it responds to concerns raised by stakeholders.
Thank you for your comment.
Thank you.
We'll conclude the public comment for item 2.
Well, before I go to item 3, I want to express my appreciation for all those who come here and provide their views. It really is through engagement that we can collectively address some of the issues that we have to deal with. And I know, in particular, the issue with ServPro, staff is going to reach out, and if they haven't already, to get to the bottom of your concerns and see what we can do. Now, with regard to item number 3, there were a few speakers today, and in the past we've had many speakers talk to us about divestment and the dangers of global climate change. I want you to know that we share your concerns and we know that you're sincere, and we welcome your thoughts about the effects of global climate change and its impact on our future. One only need to look around the world today. We see droughts in Europe, China, and here in the United States impacting food shortages, the flow of rivers, hydroelectric power, and their effects on global trade, famine, and of course, the entire economy of the world. CalSTRS has been and will continue to be a leader in making its investment decisions that carefully measure how these decisions impact the reduction of fossil fuel emissions. We do this not solely as an acknowledgement that the future of sustaining humanity on the planet depends upon it, but because it makes good economic sense for our members and their families who rely on our expertise for their financial future. One must understand that we are an organization whose purpose, and by the way, its constitutional responsibility, is to administer the system in a manner that will assure prompt delivery of benefits to its participants and their beneficiaries. All of us on this board take this fiduciary responsibility and constitutional pledge to heart. It's why we serve. Today, we'll be discussing a major initiative that will begin a process by which we may hasten our pledge to achieve net zero carbon portfolio emissions by 2050 or sooner. There's no easy way to get there, but we will consider a decision-making process that contemplates a thorough analysis of the impact of risk, return, emissions, and our funding status while we make these investment decisions. Regrettably, we live in a time when partisan politics has moved certain states to choose to ignore climate change as a material economic risk that impacts their pension funds. We cannot do that. As fiduciaries, we must take into consideration the physical and transition risks associated with global climate warming. In so doing, we have been mindful as well that we are principally obligated to pay our members the benefits they're due in a timely manner. Our 950,000 members who dedicated their lives in service to the education of our children deserve no less than our commitment and due diligence. I hope you will listen carefully to the presentations today. It offers a very disciplined and thoughtful process by which investment decisions will be made, utilizing science, climate-related data, and other analytic tools. This process is groundbreaking. And I can assure you that CalSTRS will be regularly monitoring our strategy as emissions data, climate scenarios, and the most current information become available. While we're dedicated to the same goal, we care. We care about our grandchildren, our children. We're not listening to you. We hear you. We just have taken a different path. We believe the path we are charting will get there in a responsible and timely way, while not jeopardizing our ability to meet our fiduciary and constitutional duty of paying retirement benefits to our members. I hope today you will listen carefully to the presentation that will be made on the first step on a journey to get to net zero. We are committed just as you are, and we intend to get there through analytic tools and a lot of rigorous thought and hard work. And with that, I'd like to introduce, to take over the presentation of item number 3, our CIO, Chris Ailman, who will be the maestro of this presentation.
Thanks, Bill. Let me bring up the staff that's going to present 3A, and if you could bring up the slides. 3A and B, pardon me. Want to hit forward there, Kirsty? Our fiduciary counsel and Brian Barta always enjoy it when I go back and make sure we have on the record the history of how we've looked and come to this decision. And for the record, my name is Chris Ailman. I'm your Chief Investment Officer. I think it's important to note that our focus on the climate today, there's a lot of discussion about sea change. We first had a graph about sea change back in 2003, and I remember that because I was ridiculed and made fun of in our industry magazines for doing that. But now I think people understand. You expressed a great concern about the coming change in global energy, and you first studied low carbon way back in 2015 and made a groundbreaking investment of $2 billion into a low carbon index at the time, which then, or $1.5 billion, was the largest allocation of its kind. As we went forward, we really said that carbon was a key risk to the fund. You spent the majority of 2019 studying the transition of the world to a low carbon future. From that work, the definition of what does it mean to be a low carbon future came out with really the phrase of net zero greenhouse gases in our portfolio by 2050. Last year, in September, you adopted that as a pledge. We said that the year was going to be devoted to measuring and then setting goals and targets on how we would get there. And I am pleased to say 1 year later, as we promised you, we're back with that information. We provided the carbon footprint of the global equity portfolio back in May. And we're now here before you today to set interim targets on our way to net zero by 2050, to integrate it into our investment process, and more importantly, to begin shifting our global equity portfolio to a low carbon world. And then asking you to start integrating that change of energy sources into not only the investment decisions, but also the asset allocation process. So as you can see before you, it's a very profound, long history that brings us here today, and we're not done. We'll come back in January with some more information. And then we're going to shift from September, because that's such a robust meeting with the semi-annuals, to really more of a May cycle, where every May we'll devote that meeting to our net zero transition, status updates, information, and potentially action steps each time. So we will be back in 6 months with a very thorough update of where we are. With that, I'd like to turn it over to Kirsty to walk you through what we're doing today.
Chris. I'm Kirsty Jenkinson, your Director of Sustainable Investment and Stewardship Strategies. And I've got a couple of colleagues, as you can see, up with me who are going to share the presentation. We're going to have Scott, as you know well, David Murphy from our Global Equity team, Josh Dedish from our Investment Strategy and Risk team, and then back here as well, June, Geraldine, and Brian from our respective teams are all ready to answer your questions as well. So as you can see, it's quite a team effort that we bring before you today in terms of discussing these items. So we've got two items, as you'll see from the materials, that we want to cover. There's an action item and an information item. They've been formulated and discussed extensively with staff across the branch and with Makita, your consultants, and Tiffany Reeves, your independent fiduciary counsel, who has expressed their support for them. As you'll have heard from Chris, our net zero strategy is intentionally very broad. It includes all parts of the CalSTRS fund. And it recognizes that in order for the world to have to achieve net zero emissions, it's going to happen across change in the whole global economy, not just certain sectors of it, specifically the energy sector. And then as a reminder as well, our net zero strategy has three main components: emissions reductions, investments in climate solutions, and using our influence to engage and encourage other actors within the financial markets, most notably companies and policymakers, to achieve net zero emissions as well. But we're going to spend the bulk of this morning, we believe, on the action item, which is action item 3A, and specifically the 4 recommendations that you see in front of you here. Just to sort of break those down, and we're going to go through them in more detail with each of the staff. The first recommendation, it's important to see that this is an alignment for CalSTRS with where the world needs to be in order to achieve net zero by 2050. Emissions have to be reduced 50% by 2030. So that's recommendation, is that alignment with where we need to be with the rest of the world. The second, the third, and the fourth recommendations focus on a series of actions that we at CalSTRS will implement in the months and the years ahead. These are investment decisions that will reduce our portfolio emissions by 14% in a risk-controlled manner. It's really important to emphasize that risk-controlled manner that we're going to be talking you through later. And as we go through these recommendations, and Mr. Chair, you mentioned it as well, I want to stress that we have really approached them with a very strong emphasis on analytical rigor, but also a recognition that we're going to have to continually monitor, refine, and adapt our approach as the world around us changes. But we've also been guided by the fact that we need to constantly learn and we need to constantly innovate so that we can prudently manage and prepare the fund for what is going to be a complex and an uncertain future, and we need it to be resilient within that future. Before I dive into, and the team as well, into the specific recommendations, let me just orientate you to the 3 items that we felt it was important to also include in our materials today, which was the information item. We wanted to keep you apprised of other developments that have been occurring across the investment branch. Again, as we said, this is a total fund approach to thinking about this, even though we're focusing on a particular area today. So hopefully these information items give you an update on what our fixed income teams have been doing to think about and plan for reducing emissions in their portfolio, what our private asset class teams have been doing to create a workable framework to understand our exposure to low carbon assets, as a way of guiding our investments in climate solutions and also in assets that align and support the transition to net zero whilst also meeting our risk and return goals. And then last but not least is finally activities led by our Sustainable Investment and Stewardship Strategies team, including our partnerships with many large global asset owners and asset managers around the world, which is where we continue to influence change at the policy and the companies that we invest in, and how we intend to escalate our engagement given the urgency of where that change needs to occur. So if I focus now on recommendation 1, again, these 4 recommendations ahead of you. This is grounded in climate science, and very specifically the United Nations Intergovernmental Panel on Climate Change, or the IPCC's research. Specifically, it's their 6th assessment report that came out earlier this year, which details that, again, as I mentioned earlier, in order for the world to have any chance of achieving net zero emissions by 2050, emissions have to be halved by 2030. Think of this recommendation as our interim North Star. Our success in achieving this requires us to take action within our portfolio, not least as we're talking about today, but also, and most significantly, it really does depend on the rest of the world's trajectory to net zero. And it's a reflection of the reality that climate change is only going to be addressed if all participants in the global economy row in the same direction. This is a very ambitious goal. It has significant challenges associated with the world achieving it. We recognize that. We go into this with our eyes wide open. But we believe it's very appropriate, and it's in the best interest of our beneficiaries for CalSTRS to align with what the science is telling us and where an increasing number of countries, companies, and investors are heading. So I'm now going to hand over to Scott, who's going to talk you through recommendation 2, which starts to focus very specifically on the actions that we intend to take in the months ahead. Scott.
Great. Thanks, Kirsty. My name is Scott Chan. I'm the Deputy CIO at CalSTRS. And I just want to start off by saying we don't typically adopt an investment decision-making process. So why is this important? 3 reasons. The first, and I think Bill started out with this, we want to be firmly rooted in making decisions based on our fiduciary duty and serving the mission, which is to secure the retirement future of our teachers. How better for us to do that than to align the board and the staff around a rigorous, systematic process that, number 1, assesses the risk, assesses the return, and as part of that risk-return analysis, integrates emissions into the investment decision-making process. And finally, determines the impact, if any, to our funding status and our net zero goals. The second reason is to develop a process to annually review this with the board. And as Kirsty was saying, we expect the environment to change. We're getting new data and information, and the tools are getting better. We think that the market is going to more and more price in this risk more effectively. And so there could be better ways to invest in the future, and we believe that reviewing at least annually with the board is going to be prudent. The third reason, and I think as we are proposing a science-based interim goal to reach 50% reduction by 2030, It's going to take the efforts of not only CalSTRS and our staff, but the whole world working in concert. And so towards that end, we need a way to track how the world is evolving in what we're calling a transition tracker. And that's something that we think is hard to do, but you can imagine the risk that we need to assess if we're too far in front of the world or too far behind the world. It has risk implications to our investment decision processes. And this is something that doesn't exist today, but we'll be working with our partners. We'll be working with potentially our consultants in order to solve this issue. Now, I just want to end by saying this. Chris and I, we want to set the standard in the industry in this category. We want to set this tone for our investment staff. And we believe by setting a rigorous and systematic investment process, that's how we can go forward and do that. I know of no other fund that has this rigorous process, and we'll be reviewing it annually with the board. So with that being said, I'd love to hand it off to David Murphy, who will discuss how we plan to reduce emissions in global equities.
Thanks, Scott. Excuse me. Good morning, everybody. My name is David Murphy. I'm a portfolio manager in global equity. So I'd like to discuss why we're recommending a 20% allocation to the ACWI low carbon target to reduce portfolio emissions in alignment with CalSTRS net zero policy or pledge. First, I'd like to cover why we selected this index. So let's take a look at the chart that we see up here, where we included 5 low carbon indices with different goals and objectives. If you look at the x-axis, this is the active risk, and it's the active risk of each one of these indices relative to ACWI. And to put this active risk in perspective, global equity's active risk budget is between a range of 10 to 50 basis points. And you can kind of think of this range as our guide rails to managing our portfolio's risk. And you'll notice on this chart, there's only one index that falls within our 10 to 50 active risk budget range. And then moving on to the y-axis, this is the carbon emissions reduction. These are the scope 1 and 2 emissions. And again, it's each index relative to ACWI. So when you look at the chart, you can see that Climate Paris Aligned provides the largest climate emissions reduction, but at the expense of really high active risk. You also see that ACWI ex fossil fuels is the least effective in reducing carbon emissions. And then finally, I wanted to highlight the low carbon target. It doesn't necessarily have the highest emissions, but it's the second highest. But what really sets it apart, it has a relatively low active risk compared to the other indices. So the reason why we're recommending ACWI low carbon target is because 1, it maximizes the carbon reduction emissions or emissions reduction, and it also minimizes the active risk. Secondly, internal staff has extensive experience managing this low carbon target portfolios. We started managing our first portfolio in 2017, and now we manage over $4 billion in this strategy. And then now, why a 20% allocation? We spent a lot of time discussing and debating this, and we really tried to figure out what would be the optimal allocation to this. And, we did a lot of scenario analyses. We considered up to 40% in this allocation, and our analysis showed that a 20% allocation to us seems like the most appropriate. It's in our opinion, it's a risk-controlled approach for a responsible low carbon target or low carbon transition. So in other words, this 20% allocation is enough to deliver a material reduction in carbon emissions, yet at the same time, it's not enough to significantly impact our portfolio's performance if low carbon strategies underperform. So with that, I'm going to hand it off to Josh. He's going to discuss how low carbon target, this 20% allocation, will impact risk, return, and the funding status.
Thanks, David. So it's been 3 years since I've been in front of you all in person. So I'm Josh Diedisch. I'm a portfolio manager on the investment strategy and risk team. I work with Geraldine leading the day-to-day for risk management, and then we work together particularly on the asset liability management study, and that's where we came in on this analysis. So taking the work that we did as a team and the global equity team in particular, spent a lot of time on this analysis around the low carbon target index. We wanted to look at the potential implications to the funding plan. And so we used our asset liability management study framework, something that we're going to be talking a lot about this fiscal year, and looked at the implications of a 20% allocation. And this framework allows us to work hand in hand with the actuarial resources team to make risk and return assumptions about different assets and run those through the funding plan and see what comes out and kind of what those implications are. So we did that, and we used this NGFS scenario framework, came up with risk and return assumptions for each scenario, and ran those through and did a lot of different scenarios, different allocations, everything. And what we're assuming in there is really this idea that in an orderly transition, we think the low carbon target index it would generally benefit. In disorderly and hothouse scenarios, it's a little bit more mixed. So in the disorderly scenarios, you have different time periods where it would do well and may underperform, and then more risk, and then significantly higher risk in a hothouse world. But going through all of that, running all those different scenarios, what we took away from that is really at a 20% allocation, it has really a marginal effect on the core liability metrics that we look at. So the assumed rate of return, contribution rates, funded status risk, all those things, it's a marginal impact. And one of the main reasons for that is this idea of the risk-controlled nature of the index. That's a big part of why, what is really a pretty sizable allocation of 20% has such a marginal effect on the liability metrics. And that's really what gave us comfort with this recommendation. So we're going to take this framework, and then I think we want to move forward. That's okay. Yeah. So we've used this NGFS scenario framework for this analysis. And yes.
And NGFS is?
Sorry, yes, it's the Network for Greening the Financial System. So it's a pretty sizable organization of global central banks working with academic partners. They've developed on the climate science side and the macroeconomic modeling side to provide these scenarios. They have a lot of narrative information around it, and then a lot of data as well about how these different scenarios may play out. And we thought that was a good framework for doing this analysis. Gave us a lot of room to do this. And so that framework we think is going to be useful beyond this. We're going to incorporate this into the asset liability management study that we'll be starting this fall. And just wanted to sort of tee that up now that we're developing this framework and working through that. But it's something that we'll be taking up in the later part of the ALM. And I know Chris wanted to say a bit more about this, I think, as well.
I just want to share with the board that while this might seem pretty simple and logical, it obviously is very different than most of our peers, as you're well aware that many people are actually heading the opposite direction. And clearly a lot of variability. I mean, Josh is being conservative when he says a lot of central banks. It's over 110 central banks across the world that are putting together this forecast, working with climatologists. And obviously, whenever you try to predict the future, I'll use that old quote that, predicting the future predictions are difficult, especially ones about the future. So we go in this humbly recognizing there's a lot of variation in this. I personally, and I will share that with you in my upcoming evaluation, am very concerned that we're already well on our way to a disorderly outcome. And it's a question of how much physical and transition risk that represents. Modeling the hothouse world, which if you want to stay in Sacramento, you'll experience this weekend, just the beginning of what a hothouse world is like. Picture that throughout the entire summer. So we'll include that, but I fear there's, as one of our public speakers said, a mass extinction event of a number of species, including potentially mankind. So we'll model these out if you approve them, and I think that will at least help us identify the downside, recognize that almost all of these come at a cost and have a downside. Really only the first one is the one that we hopefully might have some upside potential in. But all of these will be potentially bad outcomes. And like we say, we hope for the best, but we will plan for the worst. Kirsty?
sum up with a quick point on what comes next should you approve our emissions reduction proposal for public equities. We would come back to you and inform you as to how we will implement that recommendation over time as well. We will also share staff's recommendations for reducing emissions in fixed income. And in the immediate future, as Josh mentioned, you'll be learning more about how the climate scenarios that he touched on will be integrated into our broader ALM study. And that will be at the board offsite in the education session next month. We'll also provide more details to you in the future about how we're investing in climate solutions and transition assets in the private asset classes. In the interim, you'll be receiving a report from Nikita today about the buildup of our SIS private portfolio, which, as you know, is designed to help scale our investments in some of these opportunities with our other asset classes. And as part of our January regular update, where we go through our stewardship priorities, we'll update you on our net zero related engagement strategies and our tactics of proxy voting, company engagement, and regulators, not least the SEC, as there is a lot of work to be done ongoing with the SEC's disclosure on climate change. So with that, the team's very much looking forward to your questions. And I say there's a number of us here, there's some of us in the audience as well, all ready to respond. Thank you.
Thank you very much. And I commend you for all of your good work. May I call on Gail Miller, my co-chair of this committee, for her questions or remarks.
Thank you. Jonathan. Jonathan, is my mic on? Great. Thank you. And thank you, Mr. Chair. Your comments at the beginning, I think, are exactly really inspirational, but I think the credit goes to the really phenomenal work that this team has done. So I think that to Mr. Prezant's comments at the beginning, we have long here at CalSTRS recognized what a problem and what a challenge climate change is to the future, to our economy. And what the decision you've made today is to be, I heard you at least a dozen times between all of you say the rigorous analysis that we're going into. And what rigorous analysis really means is that we're not gambling. We're not taking a chance with your pensions. We're not taking a chance as to whether or not we'll be able to pay them. We're not making a political decision like Governor DeSantis did in Florida on whether or not ESG is good or bad. We're actually saying this is the rigorous analysis it takes to ensure your pension, our number one job, while recognizing risk, both the risk to the fund and the risk to our world and the climate. So what you've done today, first and foremost, protects our teachers, for whom we could not be more grateful, and also really does protect our world. So it is a culmination of decades of work, I think, decades of recognizing where we are. It's an inflection point for every single large institutional investor really around the world. And I sincerely hope that it sets a model, sets a way that every single fund is going to go about their analysis, their rigorous analysis, in order to ensure that we're not only protecting our teachers at CalSTRS, but really we recognize how important it is that we protect the retirement security of everyone. So I cannot express enough gratitude to this team, to your ability to assess risk, to be honest that this is a partnership and that the board has recognized the risk we're taking, each of you has, and all the ways you plan on updating us. It is sincerely nothing short of extraordinary. And sincerely, congratulations to you, but more to our teachers who have as much as secure as they were walking in today. If the board chooses to go down this path, will be even more secure in the future. So really, thank you, thank you, thank you. And that's it for me, Mr. Chair. Would love to move approval when possible.
Well, I think we have a few more questions. Controller Yee.
Thank you very much, Mr. Chair. I just have a general statement, and the general statement is just 3 words. This is leadership. Yeah, there's no other institutional investor in this nation, and I dare say even around the world, that has been through the rigor of just getting to this point. And I just have to say that I think Harry and Sharon were the only ones on the board with me in 2016. when we embarked on, really pushing for that initial investment in that low carbon index. And I know my colleague at New York State Common, kind of did some groundbreaking work, but we, just really began the journey there. But the discussion actually preceded that, as Chris alluded to, the decade before. And I think once we made that initial investment, it really gave the staff the ability to elevate its confidence and experience in terms of looking at how we could pivot the public equity fund and now to a sizable amount in the low carbon index. So I'm just really grateful that we had the foresight at that time to begin this journey. And I really appreciate the alignment to where it will be an all-of investment branch and board effort going forward. I think it's also a model of leadership with respect to transparency. This is not easy work, and we are going to have stumbles, but we'll also have some victories because I do think the world will be moving at an accelerated pace in terms of how we get to net zero. I just did have a couple of questions because I think a lot of what we're going to be dealing with as a board, and I'm really sorry I'm not going to be here to be a part of these decisions, but really it's going to require trade-offs and, just appreciating the trade-offs between kind of greater carbon reductions through larger allocations to the low carbon index fund versus additional asset class risk, as we saw in the chart. And I guess my question is, if you know already, what would give you more comfort, Chris and your team, to increase the allocation? I guess, what are the signs you're going to be looking for? And will the upcoming ALM process kind of focus on that particular question? Because it seems to me, as we go through the ALM cycle, as we do, that this becomes more and more of a consideration.
First off, thank you, Controller Yee. The answer to your question is yes and yes. We will come back with an increase in the allocation because to meet, if you adopt the pledge of 50% by 2030, over half of that's got to come from how we adjust our portfolio, and global equity is half our portfolio. So this is just an initial step, and we will need to come back to you regularly and be increasing this. 50% by 2030 is 7% a year. So it's a regular transition. What will cause that will be measuring our footprint, measuring this goal, as well as the transition tracker of how is the rest of the world, because we can't do this on our own. We need, think of all the companies and all the things you do in your personal life that has to change. How we get energy, how we move things around in every facet, building materials. So that has to change as well as us changing the portfolio. And we will address with you that tracking error chart that David Murphy showed. If you note, this is already well into the far end of their tracking error. So depending on the transition the world's making, we may need to come back to you to widen the range of the global equity portfolio. And it will be up to you as we move along. How much more risk do we take compared to the rest of the world? And that's why I think it's really important to integrate this with the funding plan and the asset allocation modeling. So we'll do the asset allocation modeling every 4 years, but we'll be back more interim steps on the transition and asking for allocation shifting over to low carbon.
Thank you for that. And speaking of measuring, it's the old adage, you can't manage what you can't measure. So just curious about whether you're seeing improvements, and this is for the team, in carbon measuring tools and disclosure and climate impact assumptions. I know every investor is kind of struggling with this, but are we seeing some progress on those fronts?
I'm going to turn it over to Kirsty and to David. It's an excellent point, simply because the lack of information, especially in small caps, and think about non-US small companies, that lack of information then impacts creating a benchmark that tracks low carbon if you can't get that out. So that information influences the tilts that don't suddenly show up in our portfolio, and we call those unintended bets. If you're overweight small cap or underweight small cap, just due to the lack of reporting and information. So we'll have to continue to push global reporting and tracking of carbon as we have. Kirsty, do you want to add something?
Yes, I can, Trolley. I just add, as you know, from our work and with Ceres as well, I think one of the major push that we're making at the moment is to support the SEC in its disclosure rule and specifically asking for mandatory Scope 3 emissions reporting from all companies. Again, because we're a universal owner, we own all companies, and we think Scope 3 is the real way to understand that. So that's going to be a major push for us and supporting the SEC on that. But I think your question around, are we seeing improvements? Absolutely markedly. I think a lot of the managers that we're working with across the public and the private asset classes are really resourcing and building their expertise and are pushing the agenda as well for additional data. So I'm filled with a lot of confidence that the transformation that we're seeing with our partners is going to help us. That doesn't mean to say that there's got to be some very significant broader policy and other kind of mandatory regulatory forces at work as well. David, did you want to?
Really not much to add upon that. You know, Scope 1 and 2 data has been improving. Do we have a ways to go? Yes, to close the gap. But where I see the biggest gap is what she was talking about with Scope 3, which is something we're really pushing for. And hopefully, you know, this in the near future, that really starts coming through, and we get more clarity into the data in terms of Scope 3.
Thank you, Mr. Chair. I echo Ms. Miller's comments. Very, very thankful for staying the course. And these recommendations before us are going to be transformative in terms of the pace at which we reach our goal. But also, as I said, the alignment, I think, will be very important. And I think just elevates the priority of all of this with the board as well. So looking forward to the work ahead. And when it's appropriate, Mr. Chairman, I will second Ms. Miller's motion. Thank you.
Thank you, Controller Yee. Ken Tang.
As an educator, as an active teacher, and a member of CalSTRS, sitting on the board, I just really want to thank you for your work. And I think, as Controller Yee says, this is definitely leadership. I don't think there's any other organization that is doing what we're doing, and this is exciting because you know, as we're hearing all of our speakers. And Bill, you know, said it very well earlier, that, you know, we're listening and we're taking actions, and it's exciting that, you know, I get to be a part of this as a teacher. What I want to know is, like, my question is that is there, I guess, ways that we can collaborate with others, pension funds and other investors to go in the same route? I know that we can't do it alone. I mean, if CalSTRS does all of this and yet the rest of the world is not doing this, then it's kind of defeats the purpose. I know that we definitely need help in the engagement portion, the collaboration portion, and I think most importantly, policy. I think policy is going to drive a lot of the decision that we make. And I think the recent, I guess, decisions of the state of California to disallow the sales of gasoline cars in, I think it was 2035. I think it's a great start, right? I mean, and so how can we you know, continue to collaborate with the different organizations, whether it be in government or investors, to continue in this process, and those who spoke, I mean, how can we work alongside with you to continue this effort? Because I think as a teacher, I look to find solutions. I don't look to abandon it, and by divesting, we're just abandoning the problem. But by continuing to do these kind of action, taking these kind of actions, I think is what's key in terms of solving the problem. So I really commend you for the work, and I really appreciate your work on behalf of the teachers. Thank you.
Thank you. I would comment on the collaboration point being so key, and I think we're very well positioned already to continue to leverage the collaborations that we're part of. There are a number of forums that we work through with other asset owners around the world and in the US, and also asset managers. So if you think about it, one of is sort of those collaborations, whether it be Climate Action 100, whether it be the series, whether it be through PRI, the Principles of Responsible Investment, there are already now quite organized groups that we will be able to share our learnings with as we learn from them. So we will continue to leverage those. I think the other area is, we're very privileged in the partnerships that we have, again, across the entire investment branch. We are able to work with all financial organizations, and I think the ability that we have to work with them is also going to be very profound. On the policy side, obviously, we do see that there are going to be some political and policy challenges in the months and years ahead. I think what's very encouraging for us when you look at it from an investment perspective is, the passing of the Inflation Reduction Act is a huge tailwind on a federal level that is now baked in for the next 10 years, which will really help a lot of the investments that we're looking at in low carbon solutions and will help to transition this further. So I think being able to demonstrate to policy leaders that investors need that kind of policy certainty because it's going to help us do our jobs is really important. And that's something we feel very strongly about with both federal legislation, state legislation, and also the SEC and regulators. So we'll continue to do that as well. I hope that helps.
Sharon?
Thanks, Phil.
Who's been here since the beginning of this. She was part of the first step.
Mr. Chair of the Board has been here longer, but I've definitely been privileged to be a part of the conversation. And I know Ms. Dillon is in the audience somewhere who's even before us. So there's a long history, I think, of these conversations happening within CalSTRS. So I do just want to say personally, I know we had the conversation last year, COVID brain, about making the pledge. And I just want to say thank you for being responsive. I know I was a vocal proponent of accelerating the goals. To me, when I hear 2050, that feels really far away. And so I just want to say thank you for listening to the board. I know you do, but I just want to publicly thank you for being responsive to that. And I think that it's really important, both for the public, for our teachers, I know for just me personally, to kind of, I feel overwhelmed by what's happening with climate right now. And I think we all have a lot of feelings and emotions and concerns about what's happening in the world. And I think when I come here to Sacramento and sit on this dais, it's really about, and then how do we think about that in terms of a lens of risk? And I really love the language of risk, return, looking at emissions, and then ultimately funding. David Lamoureux and I just gave a talk a couple weeks ago here in LA about the funding status. And every time I talk about the funding status, to me, I'm nervous about, I'm confident what our staff is doing, but I also feel like 73% is a C in my class. A C is not what I want us to be. I want us to be A's, students. And so I appreciate kind of bringing it back to data, science, research, the expertise of our staff to really give us a benchmark that is an interim benchmark. And I like your language, Kirsty, of an interim North Star. That gives me comfort that we're looking at the next 8 years, which is not a lot of time. It's a short amount of time to have this interim goal. But I think you've been responsive. Obviously, we as a board and we as a fund, and we're wrestling with the reality that the world around us is literally on fire or in a flood or hot, 110 degrees. And we're trying to make financial decisions in the midst of that and be prudent and mitigate risk and make sure we pay the pension promise. So I have comfort in having kind of this interim North Star. So I appreciate the responsiveness of staff to kind of develop that. I did have a couple questions. I would love to hear just a little bit more. I know you've touched on it, David and Kirsty, but from both of you, could you just talk a little bit more about the implications of kind of the recent SEC decision, the Inflation Reduction Act? You kind of mentioned it briefly, but I wondered if you could just maybe distill a couple of key points from those two, I think, very important decisions, not as much as I would like to have seen on the Inflation Reduction Act, but could you kind of sort of highlight or bullet point a couple of pieces of those two decisions that relate back to how you're going to be thinking about reporting back to us in the coming years?
Oops, happy to. So on the SEC, I just want to be clear, I'm understanding you correctly. So we're awaiting an SEC decision on them coming up with a new climate disclosure rule. What was really fascinating to us when we were, we obviously provided a submission on behalf of CalSTRS where we, as I said, called for a mandatory sort of scope 3 across all companies. The SEC at the moment are in basically evaluating 14,000 comments. Apparently it's like one of the most commented rules that they've ever had. And clearly are going to be, hopefully, they have indicated to us, coming out with a draft rule by the end of the year. We know that rule is going to be challenged in the courts. And so what they're trying to do is obviously to walk a very tight rope balance between a rule that is workable and pushes us forward in terms of climate disclosure, but at the same time does not get overthrown in the courts. So I think that's what we're going to be watching for over the next couple of months. And if that obviously goes forward as we hope, it will have a very profound impact on the ability for us to collect the data that, as David alluded to, for us being able to continually, monitor our progress and see emissions reductions is something that we need. So if you see, why is the SEC important? It's because it's going to provide us all the data that we need to get better analysis and understanding of our portfolio. A lot of our data at the moment is based on estimates. We don't really like, basing investment decisions on estimates. It would be very nice to have that based on data coming from companies themselves about their own emissions across both Scope 1 and Scope 2 and Scope 3. So that's where we stand with the SEC. In terms of the Inflation Reduction Act, clearly there was an awful lot of information within that. I think what's particularly interesting for us, one of the challenges when thinking about investing in renewable power and other areas is it has been a level of tax credits that had to be renewed on an annual basis. What this act does now is to essentially give you a 10-year look through and certainty around a set of credits. What I think is more interesting, though, almost, is the fact that it's not just about credits and incentives. The actual cost of energy and the production of renewable energy and battery storage and energy storage has come down on an economic sort of unit cost anyway. What this does is provide greater certainty around sort of continual boosts for that. So I think the way that we're looking at that is what does that allow us to do in terms of our investments across the renewable energy spectrum and across battery storage and energy storage, which as everybody knows, it's not just about where we get our power, but it's how we store the power. And that's really important. Plus also the boost that it's giving to other new technologies like hydrogen, which is also what's going to be required to abate some of the hardest to abate sectors from a carbon perspective. So it's bringing down certain costs of easier to abate sectors and also helping to boost the technologies that are required to really transform a number of other areas, and also helps particularly around carbon capture and storage as well, which is another way for we're going to obviously be able to manage and mitigate emissions. So those are the broad areas, but it's something the team has been looking at across the asset classes, and we're pulling together a number of experts who are going to brief us, again, as part of understanding where the world is going, what this means for the portfolio.
I just have one, if I may, Mr. Chair, another question just about leadership, because I certainly look at our colleagues around the country and then obviously overseas and look at how different funds are looking at this issue around decarbonizing portfolios and making different decisions. And it's honestly, it's unique to each system as far as I can see. I mean, everyone's kind of taking a bit of a different angle on some of these decisions or how they look at it. Some are sledgehammer, some are more scalpel. I would argue ours is more of a scalpel approach, if you will. Chris, you were talking about not wanting to be too, behind. I'm thinking of solar panels back in the day, right? Not being too early and not being too late. And my question when we have those conversations is then, how are you a leader in the midst of that? Or how do you, it's hard when you don't have, I'm thinking about the rest of the world and trying to get the rest of the world to be thinking like this or to take the kind of action that we're taking. If other funds don't do this, or if other, like BlackRock or other folks don't make these kinds of decisions, then we're going to still stay behind. So I guess I just struggle with that. Like, how do we lead? How do we set the standard while not getting too out front so that we obviously would take more risk? How do you think about that?
You're not going to like my answer because it's you're going to have to make those tough decisions. You're going to have to find that balance. What we've learned from some of our peers, particularly my friends at the Dutch funds, who have gone ahead of us and already preceded these changes, Case Depot up in Canada, is they can decarbonize their portfolio. But if the rest of the world does not do anything, they end up taking a wider and wider, think of that risk chart, that tracking your risk, tracking your risk, and tracking your could be positive or negative away from the world, shall we say. So, think of, as Scott said, that we're going to create that transition tracker, which is going to be a rough way of trying to figure out where is the world on its carbon shift, its energy shift, and how far are we from that? And that really is going to come back to you as a funding decision, which is how far ahead do you want to be in terms of making the estimation the world will change, and that will incur risk to the portfolio. And again, I want to emphasize risk can be positive and negative because I think what we're finding from the central banks is a lot of variability. That risk in terms of your carbon intensity could at times be a help to some portfolios and at other times a harm to it. So we just define that uncertainty as a level of risk, and you'll have to decide how much you want to accept, recognizing that the longer the world delays in making that transition, the more extreme the negative outcomes and more likely the negative outcomes become. So they go from a low likelihood to a moderate likelihood. And that really, I can already tell you, is going to shift down your risk return and your asset allocation efficient frontier assumptions, which will put a ton of stress on the funding plan. Again, for the public, so they recognize the current funding plan is a 50-50 chance of being fully funded by 2044. So yeah, thank you. But 50%, it does not take much before the odds are now starting to stack against you, and that's material. But I think that's going to be an ongoing dialogue. The challenge is you're trying to estimate not just the USA and not just Texas, but the whole world, and there will be uneven expectations and outcomes. And I think, back to that, the chart that Josh showed you, you'll hear us refer to that. I always get the initials wrong, Kirsty. Yeah, NGFS, just doesn't flow for me. The NGFS study, it's a helpful matrix that we will come back to look at and be able to put more numbers on as we march forward in the world. And I can already, as again I said, you'll see in a write-up from me later this month, I am already warning you that this board is going to have some very stressful times in 2027, 28, I think, to make exactly those decisions of where you want to be. I have no doubt our initial step already puts us way ahead of where the rest of the world is. And as we said, we measured the risk we're taking to the world. We think it's very prudent at this point, but you'll have to decide how much you want to anticipate that.
Chairman Kylie, Harry.
That's Bill. Harry's the best. Thank you, Mr. Chairman. An observation, a couple of comments, and then I have 2 questions. Observation, it just feels, no pun intended, but the energy in the CalSTRS boardroom, it just, to me, feels terrific today to see our boardroom full again. We haven't seen our boardroom like this in over 2 years. So as a person, it just, the energy is wonderful. Couple of thank yous. Thank you, Mr. Chairman. Your opening comments were well thought out, very powerful, and greatly appreciated. That's why you're our chairman of the investment committee. And also to Ms. Miller, thank you for your comments as our co-chair. Terrific and well done. And Madam Controller, this is leadership. I want to thank the staff, I want to thank our consultants, everyone that has worked on this item. It is a very, very compelling presentation. And as was stated earlier, this item is not gambling with the future retirement security of California's educators. This is not gambling on your future. What this is a well thought out, rigorous analysis based on expert investment decisions and thoughts from some of the smartest minds in institutional investing. It's systematic, it's rigorous, and the work will be measured on an annual basis. And make no mistake about it, 20% of the public equity portfolio is not pocket change. It's real dollars in the tens of billions of dollars. Based on understanding the risks associated with that, the return assumptions, and importantly, the funding status of this system. So I couldn't be more proud of the work that's gone into this. And I commend all of the people that are responsible for doing that. I do have two questions. One has to do with maybe a little bit more meat on the bone around the transition tracker. What is that? Who will we be working with if if it's privileged or it does not need to be made public? You can tell us in private. Is that a new measuring tool? Is it being created by one of our partners? Is it something we'll get into internally?
Happy to take that.
Please, Mrs. Jenkins.
It isn't created yet. It's a recognition of where we need to evolve our analysis, but more broadly where I think the investment markets need to evolve. I mean, there was just an article from the IMF last week identifying this gap as well, in that we don't have a comprehensive climate information architecture to help us and other allocators and other managers of money to track carbon emissions and decarbonisation in the same way that we do inflation or growth. And so what we are proposing here is, one, a recognition that that needs to evolve, and two, a request and a goal for us to leverage our partners as best we can across the investment industry, but also the broader actors within it, to help us provide some kind of way of being able to track this. At the moment, we get piecemeal information around, well, electric vehicle penetration has increased here, and renewable energy uptake has increased here. But how do you do that for a fund like ours that is trying to think about this as a total fund basis? So again, work to be done for the whole industry across the next sort of 8 years. Again, our access to partners, I hope, will help us be on a good course for that.
Second question, if we could pull up the slides that Mr. Murphy had, and it X and Y axis with the indexes. To me, it's counterintuitive. So if you could bring.
Slide 7.
Thank you, Jonathan. Thank you, Jonathan. So to me, it's counterintuitive, but Mr. Murphy or anyone, Ms. Diedisch or Mr. Emkin, anyone could help me better understand why the ACWI ex fossil fuels is more harmful to the environment and the atmosphere than the ACWI low carbon target. Can you help me understand that?
Yeah, thanks for the question.
Sure.
So, I mean, this was a surprise to me. I've got to be completely honest, to see how little the carbon emissions reduction, and again, we're looking at scope 1 and 2 emissions. I mean, out of the 5 that we have in this chart, it's the least amount. So the reason why I would say that a lot of these fossil fuel companies are probably not the biggest scope 1 and scope 2 emitters. I think some of the other companies, you think about scope 2, that's the purchase of electricity, right? and it's, could come from a utility company or wherever. I'll have Kirsty mention it, talk to it also, but I mean, this is just based on the data, right? I mean, looking at it in terms of scope 1 and scope 2, fossil fuel companies, if we divested it, it really wouldn't have much of an impact to our carbon emissions reduction.
David's exactly right. And I think the other point to remember as well is that, as we've always said, emissions lie in all parts of the economy. And so what the low carbon target allows us to do is when you actually reduce what we're essentially doing through this allocation, we will be underweighting and overweighting and tilting towards those companies with less emissions and away from those with higher emissions. And when you apply it across all sectors of the economy, you get greater emissions reductions when you don't just look at one particular sector, which is the energy sector, because materials, industrials, utilities, and lots of other sectors as well contribute emissions. And so when you think about it more holistically and broadly, that's where you get more emissions reductions because you're applying it across a broader swathe of the economy.
And that's exactly right. I mean, the ex-fossil fuels just focuses on the energy producers. If you look at low carbon target, the reason why it's so attractive to us, there's constraints in terms of countries and sectors. So if there is a particular sector where, you might not have all clean companies, you're going to have the cleanest of that particular sector chosen for this. And it's also going to be optimized to very low tracking error. So it's, again, that's the reason why it's very attractive for us.
Thank you. Thank you, Mr. Chairman. Mr. Ruffino.
Thank you, Mr. Chair. Quick comment and then follow-up question. So back in Norway, the ONS Energy Conference is underway today with many CEOs of energy companies in attendance. And in a survey that was just released yesterday, the attendees, almost 95%, voiced unanimously or indicated that climate change and political instability were greater challenges for the international community than energy security. Interesting thought that the energy companies understand, or at least acknowledge formally, that climate change is for real for the climate change deniers. Back to achieving the 50% reduction goal by 2030. Quick question, what proportion of the reduction will likely be under CalSTR's direct control versus dependency on third parties?
Nobody's looking at me. I'll lead out. It's hard to nail the number down, Frank, but my personal experience talking with peers, it's roughly 50-50. We can accomplish about half of that reduction by changes to our equity, fixed income, and then private equity portfolio. But we're really probably going to need at least half to come from think of Coca-Cola, IBM, Apple, General Motors, and all the world operates and lives. And I can't emphasize enough when I say all the world. USA represents about half of our portfolio, but the other half is the rest of the world. So China has to make a move, India, and then, our big exposures are really UK, Japan. They have to change their behavior. So that's where that transition tracker, I think, will give us a rough idea of where the rest of the world is at. As much as we'd all love a smooth, easy transition, unfortunately, I think we can all anticipate it will be a lot of stop and start, and maybe, sadly, some steps backwards. Kirsty, do you have a different point of view?
What would be the most significant hurdles in achieving the 50% reduction by 2030?
I think for us, the challenge will always be the question of the funding status and tracking error, and our willingness to balance those two and how much to take on. For the rest of the world, it's political instability. as was mentioned in the survey you referenced. I think political will, you have heard from Mark Carney and many of the leaders in this effort that they're very pleased at the business community and even the financial community pushing for a greener, more sustainable world. But we haven't seen the political will to come through. Now, obviously, the package that was just passed is huge for the United States, but you need to stick with that 2 years from now, 4 years from now, 8 years from now as you move forward. And obviously, Europe is well ahead of the USA. We need North America to continue to move, South America, and then especially Asia and the Middle East. And what we have seen of the most populous parts of the world, China and India, is a 2060 or longer perspective, and frankly, it just doesn't cut it. So I think, again, we'll plan for the worst, but hope for the best, and that's going to be something as we move forward. We already know the impacts. We're already at 1.4 degrees Celsius, and people have said that dramatic things that at 1.5 and then even 2, and they don't want to talk about the impacts over 2 degrees. But we know severe storms, extreme weather will influence the rest of our portfolio as well. So those are the variabilities we're all going to have to deal with in life going forward.
Thank you, Chris.
Controller Yee, before I go to you, I just have one question with regard to NGFS, which it played an important role in the analysis here. Are they doing anything to get more granular information on which we can rely than that which they've already provided in the use of this information that we have used here today?
Figure out who's going to answer. So they
the one that tells the truth.
So they've gone through a couple of iterations already in the scenarios that they've developed, and what we've seen just in our experience with it through this exercise and going forward, I think in the iterations that's part of most of these frameworks, and we saw that with the climate science and other macroeconomic modeling. It starts at this very wide area analysis, wide macro analysis, and they're narrowing it down more and more. Whether we would see really fine-grained, security level metrics, probably not, but I would imagine. But I think part of their effort really is to get finer grained, particularly in the regional distributions, because that's one of the important elements of their scenario framework, is this idea of the potential in certain scenarios where you have different countries, different parts of the world, going through a transition differently, different policy implications and things like that. And so the analysis that they do would reflect that, so the macroeconomic outputs and things like that. And I would imagine, like our experience will be with this, it'll be an evolution as time goes on.
The only thing I'd add to that, and Josh's absolutely right, obviously, is there are multiple scenarios out there. The International Energy Agency and other groups are also providing sort of future climate-based scenarios. Josh and the team did a sort of analysis of which was helpful, and we found the NGFS as now. But I think as part of this whole idea of, constant evolution, we're already seeing the evolution of different climate scenarios. It'll be our role to kind of iterate and determine, we might switch. We might switch to a different set of scenarios as better information comes and becomes more granular, as asset owners and asset managers demand the level that we need. And so I think we're going to have to be very nimble about how do we kind of consider what's the best inputs that we can use for our assumptions.
Controller Yee.
Thank you, Mr. Chairman. I just wanted to maybe just bring to the fore a reminder about CalSTR's leadership on a number of other fronts that will inform this effort on an ongoing basis, and that is our leadership with respect to engagement and also with respect to policy change. This is all going to be feeding into our ability to either move forward smoothly or, but I think it's going to create more opportunities. And, and I want to just thank Sharon for really pushing us to take the first step of the pledge. because I don't think anyone was under any illusion that we were just going to wait until 2050 and flip a switch. This was all informed by work already done to date when we adopted the pledge. It will be based on work that will continue to be done. And when I mentioned leadership, it really isn't just about what was presented today, but just the ongoing work that we do to just continue to inform us about the strategies that really are going to help us meet our goals. And so, again, I just want to applaud the staff for continuing to be at the forefront with respect to engagement, and that's on a global basis, and also with respect to policy change, particularly with our regulators. So just wanted to remind us that that work will continue.
Thank you, Betty. I just have one concluding question, and I would be remiss if I didn't call on Alan Emkin, who is a consultant, has been a consultant to a variety of different major asset allocators, and has, I think, seen what's going on around the world. And if you could comment as our consultant on the effort that we are embarking on.
If I can figure out how to turn on the machine, yes. Thank you, Mr. Chairman. And first and foremost, it's important for us to acknowledge that this is cutting edge. This is the most comprehensive, most thoughtful, and most detailed analysis that we have seen anywhere from a pension plan. And the staff deserves an enormous amount of credit, as does the board, because it was being done under the board's direction. Just a couple of points, and I'll be quick because it's a long agenda item. But yes, you are in the vanguard in terms of pension plans, particularly public pension plans. There's no question that you're in front. But you're joining something that's much greater and much more comprehensive than just pension plans. Commercial and investment banks are including climate change in every single one of their decisions when they do underwriting. Insurance companies, particularly casualty insurance companies, are using climate risk as part of their analysis on how much they're going to charge people for everything from fire and flood insurance to homeowners policies. Central banks worldwide are concerned about the impact on economic growth and opportunity and inflation created by climate change. Major corporations, large and small, are adopting the pledge and are taking actions to mitigate the impact of climate change and make things better. It's not just being negative, but being positive, creating products, creating services that could have a beneficial impact. Cities, counties, states, regulatory agencies are all addressing this issue globally. You are not alone. Citizens groups have become more and more informed and more active and are having a massive impact, in my opinion. In no small part, it's the citizens groups and people like you who were the force that created the Inflation Reduction Act, which is going to have a huge global impact. And lastly, it's people like you at other pension plans who will see the efficacy of your actions, and hopefully they'll follow in your footsteps and take similar actions, which are built on science, which reflect risk in return and funding levels, and really talk about the future. Thank you, Mr. Chairman.
Thank you, Mr. Chairman. We've got a motion and a second, but before we take that call for a vote, we have public comments. Any public comments?
There's nobody waiting to public comment at this time.
Thank you. There's been a motion made by Ms. Miller and a second by Controller Yee. Would you please call the roll?
Ms. Bradford?
Yes.
Ms. Hendricks?
Yes.
Mr. Keeley?
Yes.
Mr. Gunning?
Aye.
Mr. Tang?
Enthusiastically, yes.
Ms. Erden? Excuse me. Ms. Yamamoto?
Aye.
Mr. Johnson?
Aye.
Ms. Miller?
Aye.
Mr. Rufino?
Yes.
Controller Yee?
Aye.
Chairperson Prezant, would you care to vote?
Yes.
Very good, the motion passes.
Thank you very much. We'll now go to item, you want a break?
Yes.
Okay, we'll take a break. We'll take a break and be back here at 1:15.
Okay, good.
Great comments, Bill. Yeah, great comments.
And we're on agenda item 3B, which is net zero first year progress and planning update. Kirsty, is that?
I thought we did.
Okay.
I thought we did.
Oh, that was, yeah, okay. That was just all once you gave. Oh, great, great. All right. Item number 4, open session, annual performance reports. Steve McCourt and Mike Malone, and of course, Alan Emkin.
I don't know if Mika's here.
Thank you, Mr. Chairman, Steve McCourt, Makita Investment Group. I think we're presenting our report. First, the committee has received our reports in a variety of forms. We're going to go through just some oral highlights of the total fund reports. I will, and then Alan will have some comments as well. Let me start off by reminding the committee of the context of the capital markets during the year that ended June 30th. Interesting year in that the first 6 months were reasonably positive in the markets, and the final 6 months of your fiscal year, which were the first 6 months of this calendar year in 2022, were the worst 6 months in the global equity markets for at least 40 years, for start of a year, first 6 months in a calendar year, and the worst 6-month start of a calendar year in the bond markets in history by a long shot. So it was a truly historic downdraft in the markets that all investors experienced. What drove this downdraft largely was an acknowledgement and then quickly followed by the reality of inflation in the economy, really for the first time in a meaningful way since the early 1980s. And in order to prevent inflation from lasting longer than it otherwise would, the Federal Reserve, as central banks often do and are expected to do, began increasing interest rates quite steeply early in the year, and signaled to the bond market that it would continue to increase interest rates until inflation was under control. And of course, here we are into August of this year, and up until the most recent month, inflation on a year-over-year basis was still increasing. So the market continues to be volatile. In the context of this, broad equity markets globally were down about 16% or so for the 12 months ending June 30th, and broad bond markets down about 10%. That means if you are an investor invested in a diversified 60-40 portfolio, which is a common long-term asset allocation for many types of investors, your return would have been negative 12, 13, 14%-ish in that range. CalSTR's return for the 12 months ending June 30th was negative 1.3%. So significantly better than what the broad capital markets have done. And the reason for that largely boils down to asset allocation and the approach that you as a committee and the staff have taken on diversifying the plan to perform in a wide variety of economic environments. Most importantly for this past year, this was the first time that your RMS allocation, which is now about 10% of your entire portfolio, was tested in an environment where not only did stocks go down, but bonds went down at the same time. And as you know, a large portion, between a third and a half of that program is in long-term treasuries, which have had significantly negative returns for the last year, particularly the last 6 months. Despite that, the RMS portfolio was up about 6% when global capital markets were down double digits. That's a testament of a well-planned, well-designed, well-executed strategy within that allocation. So there's no victory laps in defined benefit plans. This is a journey, not a destination. But it is worth pausing just to acknowledge that the planning that was done to think through the risk mitigating strategies allocation and the execution of it has worked. The other area that has helped CalSTRS relative to other investors has been CalSTRS' continued allocations to private market asset classes, private equity, real estate, and inflation-sensitive strategies. You'll see as you look through your performance reports, partly due because of the differential in valuation dates of private market assets. Many of those private market asset classes outperform public market asset classes by 30 to 40 percentage points. So every additional percent of allocation you have in the private markets helped quite a bit over the last year. That's just some broad context on the markets and your broader performance for the year. The main purpose, just to remind newer trustees of these semi-annual reports, is that you are a policy committee and you delegate to staff the responsibility of executing the policy that you set. And to monitor that delegation, your consultants every 6 months do a deep dive analysis of the investment program and staff's execution of it. And these reports represent the conclusion from that analysis. For this year, at the broadest level, like many of the years past, the performance of staff's execution of policy has been quite strong. You'll see in our reports that with the modest exception of the real estate asset class, every asset class and the total portfolio outperformed their policy benchmarks for the year. Without exception, every asset class in the total portfolio outperformed its policy benchmark for the trailing 3, 5, and 10 years on average. That's just a remarkable observation. And one that's quite noteworthy. We would certainly expect that, particularly over shorter periods like 1 year, you would expect to see a few areas that are challenged and a few areas that do well. And in your case, you've in recent years become used to strong execution across the board. At the total fund level, your pension fund with a negative 1.3% return outperformed by a meaningful amount the return of most of your peer public pension plans across the country, in addition to outperforming the policy benchmark. As well, looking back over the last 7 fiscal years, you have now outperformed peers and the policy benchmark in 6 of the last 7 years. And as I said, including all trailing periods over longer time periods. So very consistently strong results, and this past year was no exception to those longer term observations. I'll also highlight that we look at risk as well, and the risk that the staff takes in executing the policy, because at the end of the day, number one, you want to make sure that the risk that's expressed in the portfolio is consistent with policy. But number two, to the extent that your staff is taking on more risk than policy, that risk is being rewarded in terms of higher returns. On a risk-adjusted basis as well, your total portfolio has outperformed over all time periods based on our analytics. So that's my broad, and I think I said this last year too, I'm generally not an easy grader, but it is what it is. I will note before handing it over to Alan, while the report card is a very strong one, I think staff would acknowledge there's always risks and uncertainties to be concerned with and thinking about, both from the committee level and also from staff's position. The most important of that will be the environment. As I introduced, we are in a challenging environment right now because of the rising interest rates and the pursuit of most central banks around the world to reduce the amount of liquidity in the capital markets to try to control inflation. And that may persist for some time. And your staff can't do anything about the environment. You can't do anything about the environment. But environments come and go. And what's important is that the committee go through a thoughtful process periodically to re-underwrite the long-term strategic asset allocation policy so that it has the strongest chance to achieve your objectives over any type of environment over long periods of time. I note that because, as you all know, we are starting now the asset allocation process with your staff, and there'll be items for the next several meetings related to asset allocation. And of course, the other risk I would highlight is the constant challenge to execute at a high level for the staff. The performance that you've seen from your staff in the last several years is well above average by any metrics, and there's obviously lots of decisions and reasons that allow them to operate at a very high level. And so staff's ability to continue to do so, to make strong decisions, to create governance processes that result in the type of performance that they've been able to produce is important to keep an eye on in the future as well. With those summary remarks, I'll hand it over to Alan.
Thanks, Steve. Alan Emkin, Makita. Very briefly, performance reports like this look backwards, and really their only utility is it helps you look forward. Otherwise, it's just a report card without any notes saying here's the areas that need improvement or here's the area where there's been excellence. I'm a big fan of not fixing something that's not broken. Your investment program in no way, mean, or form is broken. It's functioning at an extraordinarily high level. And some things the performance report doesn't show you, and I'm going to really try to highlight those very quickly. One is the collaborative model, which you talk about all the time, but you don't see a line item anywhere about it, except when occasionally it gets reviewed. But it's added an enormous amount of value, both in better return and lower costs. And the other is the risk allocation committee, which you don't hear about very often, but which on a biweekly basis meets and manages both risk and return in the investment portfolio. And both of those have been accretive. And it's just important to keep that in mind. And then one piece of bad news. And the bad news is, looking forward, the assets which are not publicly priced, which are a significant percentage of the portfolio, will be repriced. And they will be repriced to reflect what has happened in the public markets. So you should expect sometime over the next 3 or 4 quarters to see write-downs in the illiquid parts of the portfolio, because they're not immune to what happens in the general economy or to the capital markets at large. And that has not yet been reflected in the portfolio. Thank you for your time, Mr. Chairman.
There we go. On Alan's last point, I just want to share internally, we're having a fun, I'm having a fun running debate with Julie Underwood and the audit team because we have to estimate, when in November, you're going to get the first draft of the financial statements back to June 30. And the auditors always want to kind of at least get some snapshot, this performance report, real estate, private equity, infrastructure are lagged back to March 31. When you look at the financial statements, they want everything trued up to June 30. So going debate, we're not sure, as Alan said, we know the assets are going to be written down, but by how much? And we'll share that with you. The auditors may demand that we reopen the books and readjust. I want to caution you because what you're going to hear from the endowments and some of our peers like CalPERS, they will go back and restate their June 30 numbers with a trued up private equity and real estate number for June 30. It's confusing because then there are two performance numbers for June 30 and you're not quite sure which is which, but we'll share that with you as we get closer, what would be the trued up number. And we'll share with you what that write down is so that you know. Trust it will be, the 1 year number is a 1 year number for private equity and real estate as well, so that, whatever happened in that first or that second quarter will get captured in next year's return. But I just wanted you to be aware of that. We're well aware, like Alan said, June 30 was what looks to be just about the low so far this year. We'll see. And so it's been an interesting time period.
Significantly less than the volatility in the public markets because of the appraisal methodology, they get smoothed. So if the public markets were down 12, don't be surprised if the private equity markets are only down half or less than that in percentage terms.
Hence our debate with
Controller Yee.
I think I'm on it. For the report. And I think, Alan, you may have answered my question, but just in terms of how we can best prepare for continued volatility and potentially higher inflation, I think I heard you say stay the course, not to fix what's not broken.
To your credit and your staff's credit, the portfolio is extraordinarily well diversified.
Yeah.
They've built out the inflation sensitive, which will, in fact, hopefully fully participate if there's more inflation. There's downside protection, RMS, and a majority of the portfolios in growth assets, which long-term are expected to have the highest rate of return in order to meet your funding objectives. So in our opinion, it's a very well-designed portfolio.
Thank you. And I also want to just thank the staff for the thoughtfulness with respect to how we constructed the RMS asset class. I mean, it did its job. And I think when we saw the down performance of other funds, that actually was a factor in terms of not as well contemplated as what we had done here at CalSTRS. So really grateful for that. I had a general question about interest rates and just what the market is assuming in terms of the future Fed rate hikes. And I think I'm just trying to understand better what the higher increases will do to volatility kind of over this next period.
Yeah, so the first thing I would highlight is the markets don't generally move based on interest rates going higher. They move based on the expectation of forward interest rates changing. The Federal Reserve, particularly this week after their Jackson Hole meeting, recalibrated bond market expectations for interest rate increases by the Fed, not only through the end of the year, but more importantly, for where interest rates will now likely remain for some period of time after the end of the year. So one can expect the Federal Reserve to make good on those expectations and to increase interest rates, what now is expected to be to about 3.5% by the end of the year. If they do that, they're simply meeting market expectations, and that should have no further impact on volatility in the markets. But what's bound to happen, because it always does before then, is there'll be more news coming out about inflation. There'll be more speculation about how the Fed's path towards higher interest rates will need to change one way or the other, and the markets will move on that news. So the good news from a forward-looking perspective is the market is now expecting higher rate increases by the Fed than it was earlier, which in a sense gives the Fed more wiggle room to raise rates without causing further market volatility. We've experienced that volatility this week. But whether or not inflation is more sustained and the Fed may feel like it has to raise interest rates even further or sustain them at a higher rate even longer is another question that can only be answered as the data comes in over the next several months. What I'll highlight in addition is rising interest rates not only have an impact on the capital markets, they have an impact on the real economy. And part of the challenge that the Fed has faced and the markets in attempting to anticipate the Fed is the normal reaction of the economy to higher interest rates is suppressed spending and suppressed investment as the cost of money goes up. Housing prices go down, new house buying diminishes, car purchases go down. That's starting to happen at the margin in the economy for sure, but it's taken longer than normal because of the average accumulated savings of consumers during the pandemic. So the Fed is in a little bit of uncharted territory right now because of the uncertainty of how long the lag is between increased interest rates and suppression of economic activity. And so again, not even the Federal Reserve, with all the information that it has, knows for sure how consumers will react to higher interest rates, how businesses will react to higher interest rates. And that reaction is what really is going to determine the degree of inflation and economic activity in the future.
Steve, I have a question about liquidity. And we've talked about the predictability of interest rate hikes. And I haven't heard you address the issue of the tightening of the liquidity on the Fed's balance sheet and its impacts on how it might impact the economy.
Yeah, the Fed pulls liquidity out of the capital markets traditionally by increasing short-term interest rates. But the other thing it's been doing behind the scenes is allowing its balance sheet assets to roll off and not reinvesting in longer-term treasuries. And what that means is that there's less liquidity on the long end of the curve as well, and that filters through the banking system and the broader economy. And this isn't unique to the Federal Reserve. The ECB has started pivoting 6 months ago to from having an accommodative monetary policy, which generally pushes liquidity into the marketplace, to having a monetary policy that is restraining and that pulls liquidity back out. And so the Fed has been less public about its actions on the long end of the curve, but they are also pulling liquidity out of the long end of the bond market as well, which is contributing to the higher long-term interest rates, which also have a contractionary impact on demand in the economy. And again, like with short-term interest rates, hard to predict how long the Fed will do that. The ultimate question nobody quite knows the answer to is if in 3 or 6 months we have a suppression of economic activity that is recessionary, but inflation is still at an uncomfortably high level, which will the Fed prioritize? And that ultimately is the question that the markets will have to answer and the Fed will have to answer. That's a predicament. Indeed. And this, by the way, we've talked with the committee in the past about one economic scenario that's not great to live through is stagflation. And this is what stagflation looks like. It's the competing goal of the Federal Reserve between inflation and economic growth.
Just one follow-up question, and Gail, I'll come to you next. Has there ever been an analysis of if once we're in a recession, how long normally does a recession take to get out of it? I mean, has there been any analysis of that?
Sure. Post-World War II, you're looking at an average of 12 to 15 months for a recession, some shorter, some longer. The technical definition of a recession is generally 2 quarters of negative GDP growth, which we had in the first 2 quarters of this year, barely. So a recession generally wouldn't even be expressed until you've had at least 6 months. And partly because of government reaction to recessions, they tend to last a few quarters beyond that, but since the 1930s, not too much longer than that. And then the other element worth highlighting is the capital markets generally price in economic activity roughly, say, 6 to 9 months in advance. So often by the time you're in a recession, the markets have already priced in the recovery. So much like the pandemic, where the capital markets troughed after 6 weeks, but we were in a recession for 2 or 3 quarters after that, while the capital markets were rebounding in anticipation of an economic rebound. That's the general behavior of markets as well.
Thank you, Steve.
Yeah.
Ms. Miller.
Oh, there we go. It's working. Thank you. Thank you. I think the most telling piece of the report is our long-term averages. It's on page 48 of the PDF, just how when we look at ourselves as a long-term investor, how well we've done. And I think it speaks to your point, Mr. Emken, about, not fixing what isn't broken. But as we look forward, especially to the asset liability study that we're going to enter into, and it seems like we've taken advantage of a lot of new opportunities. We've created the new asset class. Do you think that there are opportunities that we need to be more forward-looking about that we haven't yet been? It's hard to see how this level of outperformance is sustainable given the discussion we just had on stagflation and recession and interest rates. So I'm curious if you think there's something we need to be more mindful about going forward about opportunities, or do we need to be more nimble? Like, how do you remain this steady long-term investor while still looking for new opportunities and needing this 7% average?
Yeah, I'll share my opinions and then I'll ask my associate to chime in. First and foremost, the great long-term performance was driven by something collectively you have no control over, and that is the low interest rates, which went from the high teens in the early 1980s to negative interest rates in a not too distant past. That cannot be replicated. And so that force, which drove both stock and bond prices, was the wind in the sails that allowed for extremely fast sailing. That's going to be very hard to replicate, if not impossible. It will require creative thinking, and I think to the staff and your credit, you've adopted the collaborative model, which attacks both opportunity and cost. And being creative and looking at new and innovative strategies and looking at new technologies and the transition risk and how to take advantage of it, which you're staffing up for, those will help. But nothing can replace the fact that you had an economic force which will not continue, which in our opinion will make a 7% rate of return a challenge. I'm not saying it's impossible, but particularly in the short term, I think it will be a real challenge. Steve?
I won't add anything to that. I think that captured it.
Thank you. And then if I may, Mr. Chair, just in terms of when Mr. McCourt, you talked about CalSTRS outperformance, especially vis-a-vis their peers, do you have a sense of what's contributed to some of CalSTRS' success and how we would continue ensuring that we have that same, to the extent there's wind in our sails, from what we do have control over?
Yeah, I would sort of break it down this way. Looking at your 10-year returns through June 30th, your portfolio is up 9.4% per year. Your policy benchmark is up 9.1% per year. And the median pension plan over $10 billion is up 8.4% per year. So to Alan's point, what I would say is there's been a rising tide the last 10 years. Even the average plan has done better than 7 or 7.5%. You may or may not be able to rely on that in the future. The difference over the last 10 years of 70 basis points per year between the average plan and your policy benchmark ultimately represents your decision as a committee to adopt an asset allocation policy that turned out to be superior to that of the market and your peers. And as I mentioned before, arguably the biggest factors in that are your commitment to private market asset classes. The difference between your 9.4% return and the 9.1 policy index, 30 basis points per year, can be attributed to staff's strong execution of the policy over that 10-year timeframe. And so that's how I would kind of differentiate and distinguish between the different factors that attribute to the strong performance. You have what I think is a market-leading process in developing an asset allocation for the plan that we're just starting now. And to borrow Alan's phrase of not fixing what's not broken, no reason to change that process. It's worked in the past. There's no reason to believe that process won't continue to work in the future. And I think with the collaborative model and other dynamics and processes the staff has implemented over the last decade, you as a committee have done the right things in terms of migrating staff's delegated authority and approach in certain areas to allow them to add that added value over the policy benchmark. And again, the processes for that are in place, and there's no need to change those. A lot of it, as Alan said, will come down to, will there be a rising tide over the next 10 years, or will there be a tide that's going out on us, and that none of us have any control over. I think to state what you all know quite well, the best thing we can do is focus on the process and get the process right.
Technically, when we look at all the other funds, are all of the returns net of fees from all of the funds you're comparing us to? Do we always see the returns net of fees across the board?
Yes, but I would hesitate to interpret that too dogmatically, but because you can't. These returns are ultimately somewhat self-reported and gathered by third parties. So you take their word for it that they're collecting the right information. But I think generally speaking, yes, it's fair to assume that the returns that you see are net versus net returns.
Thank you, Mr. Chair.
I just have one question, or probably a remark more than a question. I'm reminded of Mr. Emkin's admonition in one of the first investment committee meetings I attended, where he acknowledged that the only thing that you can control in terms of the predictability of returns are the reduction in fees, but you cannot control the investment returns. That is a number that you can really focus on. And I think it'd be helpful if, Chris, you could address the number that we've been able to save in fees by the implementation of the collaborative model.
Well, and it's a great intro because you're going to get, and the November meeting is extensively devoted to detailing our fee and our cost structure. You'll get the 2021 cost report. But right now it's estimated over $300 million. I think the total is $500 million over the last 5 years. And as I presented in the business plan, I think we'll hit a reoccurring target of $300 million a year and could grow to $500 million per year by savings if we continue to pursue the model.
Thank you very much. Any further questions from the board? All right. Thank you very much for your work. As always, it's very helpful to all of us. Thanks. All right. We now have the annual performance report of RMS and CIS. I think. No, wait a minute. No, real estate. I'm sorry. Once again, I can't read. Sharon, I need your help. You guys again.
Yeah, we would have been underprepared for that, so thank you for the switch. Indeed, it's a pleasure to be here with you in person once again. Appreciate, as Chair Keeley said, the energy in the room, so thank you very much for having us. We're here to present. First of all, I'm Taylor Mammon from RCLCO Fund Advisors. I'm with my colleague Ben Maslin. And here to present the semi-annual report for the CalSTRS real estate portfolio, which you just heard looks at data as of 3/31 of this year. And we'll try to provide some context regarding where the market is today in our comments as well. I appreciated Mr. McCourt's context for the year, which applies, of course, to the real estate portfolio as well. The year ending 3/31 was the best year on record for real estate, fueled by very favorable capital markets, historically low interest rates, as well as stimulated demand thanks to savings incurred and generated during the COVID lockdown. So the real estate portfolios generally performed very well during that year, and it's the case for CalSTRS as well. We'll talk about CalSTRS performance relative to the market, and you heard that it underperformed slightly for the 1 year, but nevertheless, the returns were still very strong. And I'll turn it over to Ben to describe that, and then I'll come back and talk about the current market context.
Thank you. Ben Maslin, RCLCO Fund Advisors. So as Taylor mentioned, despite macro volatility, the real estate sector had a record year, and CalSTRS returns for real estate were 27.2% over the past year. The benchmark, however, returned 27.3%. So this is the first time that we've been up here as your consultant talking about a slight underperformance, albeit only by 10 basis points. This is also the first time I've ever said in my career that 27.2% annual returns reflect underperformance. So that's just context as to where the market is today. There's really two reasons for this. The first and most impactful is property type allocation. We've talked about in the past how the portfolio is underweight industrial properties, which were by far the best performing property type, and underweight office properties, which lagged the benchmark. And that's all, consistently been the case over the last several years, that industrial properties have outperformed office properties, but this past year was really unique in terms of the divergence. And so just to provide some data, the Odyssey benchmark industrial returns for the 1 year period were 55%. So 50% of that was from an appreciation return. So prices went up by 50%, which is just a record amount for real estate. Office benchmark returns were around 6%. So a 50 percentage point difference in performance, and that can have a meaningful impact on returns as a result. The second, which is admittedly more minor reason, is the impact of the legacy portfolio. For the new members of the board, and as a reminder for the existing members, the legacy portfolio is comprised of closed-end, opportunistic, commingled funds that were invested in prior to the great financial crisis. So the average vintage of these funds is more than 15 years old. These are closed-end funds, so CalSTRS, these are not part of the collaborative model, and so CalSTRS staff really has limited control over liquidity with these funds. Today, they comprise just about 1% of the total portfolio value, so not a lot, but they continue to drag on returns a bit. And so on the chart on the screen, we've shown the legacy returns. These are the light blue column in the middle there, which shows the lower performance they had. We've also stripped out legacy assets from the total portfolio, and that's the second column. So I guess that's turquoise. And if you strip out legacy assets, the portfolio has outperformed the benchmark. The total return for the 1-year period is 27.6%, so 30 basis points ahead of the benchmark. Just over the longer term, there's been a meaningful amount of outperformance, including legacy assets, in every time period, so 3, 5, 10-year period relative to the benchmark. And so the 1-year performance really reflects the kind of unprecedented performance the industrial sector had within the benchmark. On this slide, we talk about allocations and compliance with the policy limits. So the real estate portfolio is slightly over-allocated within the overall fund. And just a reminder that the allocation target for real estate increased in June, was formally adopted in the June meeting from 14% to 15%. Today, the portfolio is slightly above 16%, but well within the policy range, which gives 3% plus minus to the target. The reason for the slight over allocation relative to the target is basically what I just described on the last slide, which is real estate has had very strong performance, while the broader stock, the equity and fixed income markets have lost value over the past year to date. So it's slightly above, but well within the policy range. And then with regards to allocations by strategy and loan to value ratios, they're well within the policy constraints. And then we thought it'd be helpful to show the allocations both by property type and geography. The left-hand chart illustrates what I was talking about on the first slide with a level of over-allocation to office and under-allocation to industrial properties. These are a little bit overstated. The office allocations include a life science allocation, which life science properties behave differently than traditional office properties. And so when you strip out life science properties, you're closer to your target allocation on office. The importance here is the go-forward impact of being under-allocated to industrial. Staff recognizes this, and they're working, and we'll talk about in closed session, they're working on new allocations towards industrial properties to rebalance the portfolio. And then my last slide discusses leverage, and the dark blue line, so second from the bottom, shows the total portfolio leverage, which has come down. The loan to value ratio has come down over the last 6 months as of March, and this is primarily due to, or somewhat due, I should say, to portfolio appreciation with core and value add assets in particular. Having lower loan to value ratios, and they comprise together 80% of the portfolio. So with that, I'll turn it over to Taylor to talk about the market.
Yeah, and I'll try to be brief and answer any questions that members of the board are interested in. Essentially, when we think about real estate markets, we always try to pay attention to the fact that there are two markets. There's the capital markets for real estate, equity and debt investing, and then there's the property markets for real estate, which is the demand for space. We're all participants in that market in many ways. On the capital market side today, the Fed's actions, raising interest rates, pulling some liquidity out of the market, have had an impact, we believe, on real estate pricing at this point in time. It's not reflected in the benchmark through 6/30. It likely will be going forward. But we're seeing in actual transactions, anecdotally, values of properties that have very strong fundamentals where you can reset the lease terms fairly frequently, like in multifamily, value declines of between 5 and 15% potentially, really depending on how quickly you can turn tenants over and raise rents in properties that have longer term lease terms or that are facing more demand pressure. We're not seeing much of a market for these at this point, suggesting that the bid-ask spread between sellers and buyers is pretty wide. So the pricing for those has potentially gone down much more meaningfully at this point. At the same time, on the property market side, even today, things are very, very strong. There is an ample demand. Rent growth has, the pace of rent growth has declined over the past few months, but it continues to be very high, demonstrating ample demand in the markets. All of this is playing out, will play out in coming months. We might see some property market fundamental declines if and when the economy slips into more of a recessionary period where we actually see some job loss. But for now, properties, including within CalSTAR's portfolio, are operating very well. So with that, I'll pause and see if members of the board have any questions.
Sharon?
Yeah, that's interesting. I'm just kind of, that's an interesting statement you just made, you know, because I'm just kind of, yeah. So it'll be interesting to see what the next couple of years, I guess. We know we only know what we know right now. So I'm just pausing there. Ben, I had a question when you talked about life science. Is that the same as biotech? Are those,
Yeah.
Okay.
Yeah.
I know we're in that space, and I certainly, every time I go to Boston, I'm just like, wow, seems like that's the heart of biotech over there. So I was curious with the language. But in real estate, you call it life science. It sounds so academic.
Every industry has to have its own language as a barrier to entry.
That's right.
Yeah, exactly.
Yeah, I guess I'd like to hear maybe more of your thoughts, Taylor, on, I think office space. Obviously, I know we're going to talk about HQE at another date, and Bill and I serve kind of oversight on that project. But I am sort of curious. I know there's just a lot of questions right now about the future of work,
right?
What it's going to look like for people coming back, even in our own building. But I certainly am watching what's happening in Los Angeles. And then I have a niece that works for Apple, and it's every other week that she's getting a different direction on, can she go surfing, or does she have to come in, So I think it's an interesting time. So I'm really fascinated by some of these dynamics. So I just wonder if you could talk a little more about, obviously for us, I'm thinking a lot about HQE and kind of leasing our building that we're in right now. But I know you can't tell, but how do you, as an advisor to us, think about advising our team, our real estate team, on times like this that are so churny, and I'd just like to know more of your thinking on the office space piece.
Yeah, absolutely. And I'll initially answer the question about how we do it. And what we try to do is identify trends that are admittedly happening in the past, but are likely to continue into the future, both potentially caused by COVID as well as pre-COVID as well, and try to see where, the famous Wayne Gretzky saying, where the puck is going versus where it is today. On the office side, we saw a long-term trend toward more remote work pre-COVID, particularly in geographies with greater demand from tech tenants in particular. So this was happening pre-COVID, and COVID truly accelerated it. The other thing we do is look at the percentage of jobs, the number of jobs that were formerly done in offices that could conceivably be done anywhere. There's a lot of back of house jobs. We see productivity increases when people that primarily work in call center positions do that from home versus in a large call center and so on. And when we look at that, we see there's probably somewhere between 10 and 15% of jobs that used to take place in offices that really don't need to be. And so the 85% of the employees, even if they're working hybrid schedules, probably need to come back to an office at some point, and that may not diminish the overall demand, the space requirements for that 85%. Nevertheless, if 15% of the demand just simply evaporates that was formerly in offices, now they're working from home, that's pretty meaningful. And we are seeing that play out in real time, particularly in the types of offices those employees formerly occupied, which were older generally. Maybe they were considered Class A, but they're kind of older. And so the bifurcation in performance between new office and old office is now we're defining as pre-2010 at this point, is meaningful. All of the absorption that's taken place since the beginning of COVID, the positive absorption, has taken place in offices built after 2015, remarkably. So what we're seeing is a shift to quality for the employees that remain in offices. And amenities, ESG factors are incredibly important to office occupiers and so on. So those offices are doing better, while the older office stock is likely going to improve somewhat as people come back to work in coming months, but likely going to need to be redeveloped. That'll be an opportunity.
Just one thing to add on CalSTR's portfolio. The office portfolio has done exceptionally well over the last decade. Really outperformed the office sub-index of the benchmark. And that's because it's a relatively new portfolio. CalSTRS has developed a lot of new office product that has essentially delivered excess returns. So even though you're over allocated somewhat to office, it's a better positioned office, much better positioned office portfolio than the market as a whole.
Controller Yee?
Chairman, and thank you for the report. I was curious, we've seen lots of headlines this summer about flooding taking place in some unusual places, and I was just curious as to whether some of the physical risk models are keeping pace with what's happening in real time.
Yeah, I'm happy to. So what CalSTRS, as a leader in the space, as well as some other leading pension funds have been doing, is exploring alternative resources, including those driven by data science, machine learning, and so on, to better assess where floods and other physical risk factors are likely to take place in the future. Even 10 years ago, you could get a project through almost any investment committee in the country by saying it's outside of the FEMA flood zone, for the 100-year flood, essentially. That really no longer cuts it at this point in time. And so I think the data has gotten much better. It'll get even better in the future as investors demand it. So CalSTRS and its partners are utilizing those types of models to ensure that they're both managing the existing portfolio, potentially getting out of assets that might be stranded either policy-wise or based on insurance companies, or physically stranded in the event of a flood in the future, and to ensure that the new portfolio is in sites that are more secure relative to floodwaters and wildfires in particular that pose the most serious physical risk.
That's hopeful. The trends that you're seeing in the retail space, are you seeing those in our portfolio?
You're underweight retail relative to the benchmark, and that's intentionally so, and was a smart move. You're also don't have any regional malls really in the portfolio as well. So where you've been focused is neighborhood centers or grocery anchored centers, which have been a little bit more internet resistant than malls. And so that has mitigated the impact of e-commerce adoption on your portfolio. What you're not getting is capital appreciation in the retail sector, though. It's just simply because of, as Taylor mentioned, there's two markets, and the capital markets are less interested in retail than they are in industrial properties.
And then one last question. I know the increased competition in the multifamily housing and industrial investments. How much of a challenge is that going to be in terms of CalSTRS increasing our share of those investments?
Yeah, it is a challenge, certainly, in particular because of where pricing has gone. We saw a value appreciation of 50%. That means everything is 50% more. The advantage that CalSTRS has in that area is its long history of utilizing the collaborative model, including in industrial. So CalSTRS' ability to work with direct operators of industrial, developers of industrial, in order to deploy more capital and benefit from the returns that result from taking some additional risk and developing or buying a vacant building should be beneficial. They're buying wholesale instead of buying retail, essentially industrial. But nevertheless, it is a challenge, and it's oftentimes the biggest dilemma investors face. I'd love to be in industrial and multifamily, but can't afford it. So we have to find ways to do that. Just as was said earlier, it's also helpful to do so through partnerships that have less fee drag, companies that CalSTRS has a long-term relationship with and is partnering with directly rather than through multiple layers of fees.
Great, thank you. Appreciate the responses. Thank you, Mr. Chairman.
Harry, you're up.
Thank you, Mr. Chairman. Ben and Taylor, thanks for the report. It's good to see the two of you. I have a question, and I'm not sure whether or not it's appropriate for now or it's actually linked to the asset liability study and the modeling and scenarios that we'll be looking at. And so let me see if this is appropriate for now or something that maybe a request for information. But as I was looking at the risk report that is also part of the agenda of today's meeting, I couldn't help but note that the 80% of the risk exposure of the portfolio is linked directly to public equities and private equity, which represent about 55% of the allocation, but 80% of the risk. So real estate is about 15 or 16% currently. It's a little bit above the target, but within the range. So a layman's analysis would be we have a larger exposure, but the actual risk to the portfolio is lower. So one, I guess my question is my understanding accurate?
Do you feel comfortable in answering that question?
We might not be the right target for it.
We might take up. I'm not sure that the consultant for real estate is going to be able to answer that. Okay, we have a contestant.
Step right up.
The right one.
So yes, we are going into the ALM, and yes, your interpretation is correct. So the volatility in the portfolio is coming from our growth exposure, which is the equity, the public and private equity, and real estate is much less, the number you said.
So, great. So then my request for information would be, as we're doing the ALM study, to look at modeling that would increase real estate exposure while reducing our overall risk. I don't know if that's something the staff is running through, but if I wanted to get this, look at generating the types of returns while minimizing risk, I might be completely wrong, and I probably am. But when I look at the numbers, I would say, well, why wouldn't we dial up our exposure here while reducing our risk? And so my request is for that, Mr. Chairman.
Fine.
If I could just talk about the process. If you look at attachment 1 from the item today, it talks about the ALM process. In May, we're going to come to you with some wide range of portfolio options. And it'll say, how happy are you with this risk and return? And it'll have different weights for each asset class. And then we're looking for direction from the board saying, I'm happy with that because, yeah, it reduces volatility, but it may also reduce the return. And we're looking for you to give us direction. So that'll be May.
Before then.
Okay, we're happy to do that.
May's a long way away.
Well, you'll see, excuse me, there's every meeting, almost from now till then, we'll be talking to you.
Thanks, Harry, preparing you for that moment.
Thank you.
Mr. Chair, it probably goes without saying, but we agree with you. All as real estate villains, you know, we understand the analysis perfectly. Yeah.
Any further questions? Okay, thank you very much for your good work.
Thank you, Ben. Thank you. Too.
Moving on, we now have the private equity performance report.
I know.
Thank you. Lower risk, John Haggerty, Ted Ferguson,
Right.
McKean Investment Group. I'll provide a very brief executive summary of our materials, and then we'll touch on the highlights of the open session report. So to commence with that, performance very strong. Appreciation for the period that we're talking about with the semi-annual reports, which is through the March 31 period. That trailing year period was 24.2%. So you're going to hear some echoes of things you've heard from real estate, and you'll hear some echoes from things that Steve McCourt and Al Emkin said as well. We'll do our best to fast forward into today, given that the markets have changed. But the performance very strong, exceeding the custom benchmark for each time horizon, as well as the custom custom State Street Index, which is the one that is basically the peer index that mirrors your exposures to buyout, venture, and debt. The performance has been driven by the buyout part of your portfolio, in particular the non-US part, which has been particularly strong, and I'll give you those figures in a moment. Pacing is also something that we're focused on. Many of the prior meetings we've come to you and said that we're looking for the gap to the target of 13% to be met through different pacing. And we're happy to report that for this very important asset class, which is driving a lot of the growth in your returns, that you're now not only at the 13%, but a little bit beyond that. The co-investments have been a big part of that. Co-investments give you the immediate exposure as opposed to committing to a fund, which takes some time to give you that exposure. And as of today, you'll see some other figures in our report, but we're at about 20%. So a fifth of your deployment and a fifth of what you've been putting to work has been in the co-investment realm, which is a key part of the collaborative model and fee reduction. I'll also mention risk very quickly. It's not something we talk about a lot in our reports, but you're extremely well diversified. No one position in your whole portfolio accounts for more than 1%. So on a individual company level, you're quite diversified, but also you're diversified by geography and strategy type, which we'll talk about in a little bit. We have no concerns to express, just to keep it quite simple and brief, and we have no policy recommendations at this time, though we're in constant dialogue with your staff about things that could be changed in the policy to make it easier for them to achieve their objectives on your behalf. With that, I'll get into a little bit more granular detail on performance. I mentioned the 1 year, that's the trailing figure through March 31 for 12 months was 24.2%, so astounding on an absolute basis. I'll also focus on the 10-year. These are very long-lived investments that are made, and this is a long-term asset class. So I'm happy to report that the 10-year return for the private equity program, 14.7% as of this snapshot in time. That compares very favorably to the custom State Street Index, which is 14.1. And the custom benchmark, which essentially answers the question, what are you gaining versus having invested in the global stock market? The gap is astounding. So for the 10-year period of time, it's 11.7% per year advantage over having invested in ACWI index plus 1.5% to account for the illiquidity. So performance very strong. I would also note a trend, which is quite positive, in the relative performance improving. And so we've seen with each subsequent report that we've provided that these comparisons to benchmarks are getting better in addition to those very strong absolute returns. I would also say that if you look at your portfolio, as you've had very strong deployment in the last couple of years, a very small amount of the portfolio on a NAV basis goes back to prior to 2011. And so it's going to be the more recent deployment that's going to be driving your portfolio going forward. I'm going to unpack strategy returns just a little bit to talk about where the returns have come from. 90% of your portfolio comes from three categories. That's buyout, which is 75%, 10% in venture, and only 5% in debt related. So that's the full 90% of your portfolio. So I'll just speak to those, and I'll speak to the 10-year period. Positive return relative to the custom State Street Index for buyouts. Fairly equal return to that peer benchmark for venture for the 10-year, despite significant challenges of scale. When you're deploying the amount of capital that your team is deploying, it's very difficult, of course, to access very tiny venture capital funds, and that's the nature of that market. And then on the debt-related side, again, a very small part of your portfolio, just 5%, but more or less equal on the 10-year period of time. With that, I'll turn a little bit to another unpacking of performance. You've been very active in co-investments, and so it's important to take a look at how the performance is relative to funds and relative to the total program. And here the report is positive. For the 1, 3, 5, and 10-year period of time, you see co-investments outperforming the total figure for the broad private equity program, which is you want to see. You're making a big investment in that program. It's a big part of the collaborative model, and you want to see premium returns from that, and you are seeing that. I mentioned that you're roughly at 20% with co-investments. The snapshot that we showed as of March 31 is 18%. So you saw roughly 15% a year ago, and then 18%, now 20%. There has been dialogue in the past of that number moving to a higher number with a further expression of the collaborative model, say 25%. Last thing I'll mention before turning it over to Tad for implementation is performance by geography. Our report points out that the selection of strategies outside of the United States was particularly strong, and that's what was driving outperformance for your plan. So I'll turn it over to Tad to talk about some implementation matters.
So good morning, Tad Ferguson with Makita. And I'll just spend a couple quick minutes on the approach to implementation and some summary comments going forward. But overall, the portfolio continues to be implemented on a very disciplined and consistent manner. And a key component of that is the annual commitment pacing amount. Staff has been very successful in kind of reaching and achieving their annual commitment budgets. It's been approximately $8 billion over the past couple of years, and they've been able to hit that in a very successful and disciplined manner. Year to date, or I guess as of first half of the year, they successfully committed $5 billion to the marketplace. A little bit above pace, but as we entered in 2022, it was a very crowded fundraising environment, a lot of strong opportunities coming back. So a lot of this activity was a little front-loaded in the calendar year. But as we discussed with staff, we still think it'll be within their annual commitment budget, maintaining that discipline in their selection and actual sizing per annual year. And we've seen the deal flow being honed down and that actual activity levels moderating as expected. And just want to reiterate, this $5 billion in our report, we list the commitments for the first half of the year, and just want to highlight that we added a column in there that shows the percentage of NAV of each of the commitments. As you recall, at the beginning of the year, this year, there was new policy language for the private equity, where the language expressed the delegated authority limits as a percentage of program NAV. So we've incorporated that into our report just for a quick scan that, we are monitoring that closely. You all can reference it closely. And if you look through that, those, and it's on a basis point kind of presentation because it's the limits are 2% for co-investments and 4% for diversified vehicles. But if you look through that, transaction activity has not changed significantly. Commitments and activity have been well below those limits. And that was as expected as this policy language was to allow for flexibility over the long term as the program and staff evolved. That being said, I will move on. Well, I guess, and I just want to clarify, I've described a very consistent capital deployment that the staff has successfully done. Our vintage year chart in the memo looks a little bit more lumpy, and that's a function of, that's more pure vintage year where capital is initially called or initial investments made, or even how unfunded commitments are categorized. And that can be skewed a little bit with the use of subscription agreements. So while, staff has consistently committed capital, the vintage year chart that we put looks a little bit lumpier. Overall, the program is highly diversified across investment strategy. All segments are within the parameters outlined in the investment policy. As John mentioned, buyout is the largest percentage at 75%. This is well within the target of 60 to 85% as outlined in policy, followed by venture capital at 10%, and the remaining subcomponents at 5% or less. So overall, policy construct is in the parameters, and at the 14.5% total allocation as of 3/31, that's within the band of the plus or minus 3% relative to the 13% long-term target. So I'll just kind of quickly provide a couple summary comments and see if John has any additional comments, but then open for questions. But overall, program performance remains very strong on an absolute and relative basis, successfully achieving the long-term target, a combination of consistent capital deployment and strong performance. Implementation of the collaborative model continues to be an emphasis for staff. As John mentioned, it's now 20% of the portfolio. Performance has been strong, outperforming the fund's performance as expected, so really being a strong contributor to the portfolio. But as it has been mentioned, this data is as of 3/31, and we are expected performance to moderate going forward as underlying holdings are marked to market over the next several quarters. That being said, the portfolio is a highly diversified portfolio. There are no specific factors or exposures that we are particularly concerned with, but we'll continue our dialogue with staff regarding the portfolio and the markets in general, and we will really maintain a high level of dialogue with them going forward. Pass it back to John to see if any questions or any additional summary comments, and open up for questions.
Questions?
Betty.
Thank you both for the report. I was just curious whether you've seen any progress or impacts on ESG disclosure, either pursuant to the ILPA or Carlisle initiatives in this space.
So that's been a subject of a number of our calls with staff, and I would say when we look across the industry, we're seeing fairly slow progress in private equity. And we have a number of clients that are wrestling with how to do this, and there's no kind of consensus about how it's going to be done. We talk with your staff about it. One of the first steps that can be made is to look at broad industry classifications and using that to apply to the portfolio, and also starting specifically with co-investments, because they are individual or discrete investments where it will be easier to make a classification on those as opposed to funds. But if I may, broadly categorize what I'm seeing across the industry is fairly slow progress relative to what you'll see with your liquid strategies. And we're in a period of catch up to what you're seeing with your stock portfolios, your fixed income portfolios, and your hedge fund portfolios.
Not the greatest news, but is there any possibility of trying to just do a more granular focus on co-investments to try to accelerate some activity in this space?
There's dialogue about that, and I would I'm not privy to the details of what your staff is doing on the co-investments, although we have invited our expert on ESG matters to a number of staff calls, and we're engaged in a dialogue about what we're seeing peer funds to you doing, and if that can be constructive to what is being done here. But the focus on it.
people
Yeah.
in closed session.
Yeah, we can do that.
And I would just add, some of the dialogue too is across, the use of estimates versus actual data, bringing, being early and inaccurate or, late and accurate. So that's part of the balancing act of what's the appropriate balance between being quick, but also being as accurate as possible.
Later.
Ms. Miller?
Thank you. I have a question on pacing, just pacing in private equity. Congratulations, because I was a big skeptic that we could get to 13%, and now we're over that. Just in terms of when you speak about deal flow and risks in the future, what to look at when we look forward as to, are there any risks in our pacing or anything you would want us to be aware of as we go forward?
So I'll attack this in two ways. First, on the pacing side, pacing is done according to a model. Your staff has their own model. The staff's advisor, Cambridge Associates, has a model. State Street has a model. And Makita has a model. And we've gone through a process of reconciling each of those models. Each takes a slightly different approach and uses different assumptions to effectively forecast a budget for an upcoming set of 12 months. We've recently gone through that exercise and have come up with, at least independently, Makita came up with a figure I think that is very close to the others that were calculated. It's similar to prior years. I would also amend a comment that Tad had said earlier about deployment this year. And what we're hearing from your staff, and of course they can comment more on this later, is that their intention is to deploy in a very similar way to last year in terms of quantity, which might be $5 billion to funds, and instead of 2, which was the target last year, perhaps 1.5 this year, with a somewhat more discerning diligence approach to the co-investments as a means of perhaps reducing that amount. So that would add to 7.5, a small difference from prior years. So there's a lot of work that goes on to reconcile models from multiple sources that try to get at that optimal output or optimal deployment for the next year to hit your targets. Your other question had to do, I think, or the other component to it was what do you do at a moment like today with deployment? And I think what I would say, and not on behalf of staff, but I think on behalf of generally how the industry approaches deployment at times like this, is recognizing that if 80% of what you're doing is in funds, there's a 5-year investment period where effectively you've outsourced the market timing call and some of these tactical moves that you can talk about in other asset classes to the manager, to the general partner. So it's very, very hard to time any sort of market, but go back to one's fundamentals in effectively a bottom-up selection process, which is low leverage, low prices, things that have been successful in the past when you're selecting managers. Are they price disciplined? Have they used a lot of leverage in the past? Et cetera, et cetera. I don't mean to speak on behalf of staff, but I'd say generally that's an industry approach to times like today where prices are high and you're seeing bad signals from the stock market.
Just a final question on, the long-standing question at CalSTRS about managing risk in private equity, especially just because it's obviously riskier than a lot of our other asset classes. Just your assessment, given sort of how much we've changed, I mean, that was really helpful in terms of the lumpiness. I like that description, just where you think we are and lessons learned going forward.
Yeah. Broadly speaking, to follow on Harry's question earlier about asset liability, if you were to take your portfolio and look at where you're allocated versus some broad concept of what risks exist in the private equity market overall, you could argue that you're somewhat less risky in your posture because you only have 10% of your portfolio in venture, for example. You do have 5% in debt related. And the buyouts that you have tend to be on the larger side. And there's even a portion of the portfolio, it's only 2.5%, that is in so-called long-term strategies, which are, one could easily argue, are lower risk. So I think you're like structurally, you are somewhat lower risk than the broad market, but measuring what the broad market is a challenging exercise for private markets. But I think you could fairly say that you have lower risk posture than the broad market because of the things I mentioned.
Any further questions? Well, Jennifer.
Thank you. Just following on Ms. Miller's question, I think as we move into the asset liability study to this question of risk, given the outlook and given what we need to achieve from this growth engine, I think it will be interesting to understand, given how we're positioned on risk, do you continue to recommend that positioning and also recognizing the market constraints as well?
Yes.
Great.
Thank you.
Noted.
John, Tad, thank you very much for your presentation, and have a good afternoon. Okay, the next item up is 4D, and it's RMS. Finally, I get to RMS and CIS. Steve McCourt, welcome back.
I have Stephanie Sorg with me as well. She'll be presenting
Welcome,
the
Stephanie.
CIS open session. I'll be handling the RMS, and this is a oral report for open session. Just as a reminder, RMS was a new asset class for you in 2016 and was developed, as I had alluded to before, to help the fund withstand negative equity market environments at that time. Because it was a new asset class and a more complex asset class in the way it's implemented, the committee engaged Makita at that time to do enhanced monitoring of that portfolio. And this separate semi-annual report reflects the results of our enhanced monitoring there. Similarly, CIS as a investment area for CalSTRS is recent, and last year or so, the committee hired us to do enhanced monitoring of that part of the portfolio as well. So summary of our report on RMS, similar to a lot of the other asset classes this year, is that we're quite pleased with the results and implementation of the program. RMS in the last asset liability cycle, its allocation was increased from 9% to 10% as a target for the fund. And on June 30th, the actual allocation to RMS was a tinge over that at 10.25% of the total portfolio. Performance, as I noted before, with RMS was satisfying for the past year. The total RMS asset class returned 7.8% for the year, and as noted, that was in a year where both stocks and bonds were down significantly. The policy index for the RMS asset class, which is a combination of indexes designed to reflect the underlying broad strategies within the asset class, was up 7.6% for the year. So the design of the asset class worked well, and the execution added some return above the policy as well. I do want to note the variation of returns within the asset class because it is noteworthy. As I highlighted, a little more than a third of the allocation to RMS is in long-term treasuries, which did not have a great year. They were down 19% for the year, but that allocation was offset by the positive performance in the other three categories, most importantly, trend-following strategies, which were up 34% for the year. So as much boils down to in the investment designing process, being able to marry strategies that zig and zag at different times and provide diversification helps mitigate volatility, and we certainly saw that within the RMS asset class. particularly in the last 6 months when the bulk of the negative performance in the global markets happened. The global equity markets were down 20%, which is technically the bear market threshold. And the overall RMS portfolio during that period was up 6%. So very strong results. The program performed as we would have hoped it would during this time, and we will continue to monitor staff's execution of it. And with the asset allocation process starting off, we will also be working with staff to look at RMS in the context of the overall portfolio as well. So maybe I'll pause there to see if anybody has questions on RMS before we shift over to CIS.
Seem like there were any questions. Go ahead.
Thanks, Mr. Chair. I was curious. I think I've read in a couple of other places that other funds are looking at the RMS kind of strategy. Can you just comment on that? And how, I assume we were the first to kind of look at this RMS strategy. How much? I'd love to just hear how other funds are adopting this or thinking about this strategy.
Yeah, you were, as far as I'm aware, you were the first large public pension plan to adopt a formal RMS program. Others followed you, and there's been sort of a growing acceptance of it in the marketplace. I'd say the interest in it has grown a lot in the last 6 months. I think the reason's a little nuanced because most pension plans historically have relied on fixed income or long-term treasury bonds. That's their sole risk mitigation. The real challenge of designing the RMS portfolio was to integrate these other strategies that would have a high probability of doing well during those rare environments where stocks go down and bonds go down at the same time. And that's what we've seen in the last 6 months. And so while RMS has worked in some of the, if not all of the market drawdowns that you had from 2016 through earlier this year, this is the first market downturn that really tested the program's ability to produce positive returns, even when bonds have a negative experience and the long-term treasury bonds have a very negative experience. So that was gratifying, and that has gotten a lot of interest from other public pension plans. And
education.
Yeah.
And they talk about more modern portfolio theory, or think about kind of what's happened in 2008 and even what's happened now. And it just seems important to think about how the world has changed. So thanks, Steve.
Yeah.
That's all I have, Mr. Chair.
Jennifer?
Mr. Chair, and thank you for the report. Any notable changes given that our size and just the challenges that presents in terms of implementing what we're seeking to do here, together with the capital flows that have or may continue to enter this area and the market dynamics where we're in this unusual period? Just any concerns about the probability as we look forward of our portfolio as it's currently constructed, doing what we want it to do, and which it has done so well for us?
Yeah, so there certainly are implementation challenges with the program as at its current size, let alone if it were to be scaled up in the future. You have a few things going for you. The two largest components of the program by far are arguably the most liquid components as well, the trend following and the treasury component. Treasuries obviously are imminently scalable, so no concerns there. The trend following component, underlying strategies tend to be quite liquid. The challenge is identifying good managers, monitoring them, being able to find and replace them. And our experience so far, our observation so far is that staff has developed and stuck to practices that have allowed them to implement successfully in that way in the trend following area. The global macro and the SRP components of risk mitigating strategies are always going to be the more challenging ones from a liquidity standpoint, access standpoint. And that's part of the reason why they represent such a small part of the overall program. To date, our observation that staff has been able to implement those programs in a way that those allocations are performing the way that they're intended to perform in these markets. But obviously that'll be liquidity for those two components in particular will be an ongoing area of interest for us and concern for staff.
Thank you. Is Stephanie going to address the CIS?
I will be.
Yes, thanks.
So Stephanie Sorg with Makita Investment Group. Happy to be here and presenting to you all in person. Hopefully my charming personality comes through just as it did over Zoom, but we'll see. Awesome. Well, so this item is an extension of the semi-annual updates to the board that verbally summarizes the quarterly monitoring procedures of the private portfolio for CIS and our assessment of the team's ability to execute and achieve the sustainability objectives. And so in an effort to really not bury the lead here, the team, even so early into the process, has really been performing at such a high level, which I'll touch upon some of the specific areas here in a second, but there really is so much, and reiterating points already made, there's already so much to be so proud of with this group. And so obviously the ratings and report card that we have, yes, we're hard graders. Steve mentioned that before, but they're all high marks here across the board. So some of the areas that we focus on at a 10,000-foot level here from a policy perspective, there's been no deviation or breaches in the stated policy to date. When we take a look at the objectives of the sustainable goals here, there are to date 5 sustainability projects that are being executed by the team across both the scaling and new opportunities portfolio. So 4 low carbon solutions and 1 affordable housing project that we can disclose at this time. Something that's equally important here is the growth of the pipeline. And, not only does it have breadth, but it also has quite a significant depth to it as well. And that's just a testament to the team's mapping exercises and diligence on their end. Just in the past 6 months that we've been holding quarterly calls with the team, that pipeline has grown by 145%. So just that number alone is quite impressive. And that's both due to collaboration with other asset classes as well as independent organic sourcing on their own. And so definitely a lot there, obviously a green rating for them, or highest marks, I should say. When we take a look at fees, the team has sufficiently demonstrated the ability to negotiate favorable economics across the board throughout all the investments. When we look at it from a numbers perspective, that's roughly $7.5 million in savings and management fees per year, 50% reductions on certain carried interest due to the fact that co-investments have a fee-free savings there. Although there isn't a track record just yet for performance to be evaluated, the size of the portfolio is quite significant. $491 million in assets it's quite notable that's been committed. When we take a look at the team, it's well staffed. Not only in numbers, there's double digits on their team right now, as well as the composition of the group. We're seeing contributions across the board from people on the team. So. We're quite proud to see how that group has been developing. I'll hold my comments there. I won't go into specific details on any of the investments, but we're happy to answer any questions at this time.
Any questions? Stephanie, thank you and welcome. It's nice to see you in person.
Thank you.
And you oversold yourself. No.
Very charming for her.
Yeah. Well, thank you again, both of you. Stephen, as always, thanks. So we finally get to our CIO report.
I'm going to mix things up and actually start from the back and come forward.
In the room or?
I want to start with attachment 3. The poor person keeping or typing this would appreciate if I turn my microphone on. Chris Ailman, Chief Investment Officer. I'm going to start with attachment 3, which is, we have 2 attachments in this month that are unusual. So I want to highlight those, especially for the teachers in the back and the audience. The first is the special mandates annual report under our special mandates policy, which is something unique, but these are mandates that you, the board, directed staff to implement. And so they're special and they're unique in that structure. We keep track of them. As we've stated, many of them started a long time ago, all the way back in 2003. But we want to report the performance to you separately so you see that. And then also I think it's every 4 years, we have the consultants take a look at those. And they are currently reviewing those. And if they think they warrant bringing it back for you to analyze that or evaluate that program, then we'll do so. The other report, which is attachment 1, is a divestment report. The divestment cost is something we've reported to you pretty regularly in the CIS semi-annual report, or it was in my CIO report. It's not something you usually have asked for, so I don't spend a lot of time on things that you're not asking about. But we've had a lot of stakeholder interest in it all of a sudden. So I delegated that over to, it has been done by CIS for, 15 years, and handed it over to Shafat and the performance measurement team who reviewed the calculation back to history. I'm thrilled to say they came up with the same number. And then even ran the methodology by Makita, who approved of it. So because of the external interest, we're going to start publishing this annually. And then also there's been interest, you haven't asked again, but the public has asked about what's the cost or what are the returns of each of the divestments we've done. Because right now, as you can see in the report, it's $9.4 billion loss. The vast majority of that is compounding, and it really starts with tobacco because you divested of tobacco in the year 2000, and so 22 years later, things compound over time. But now we've gotten some public interest on the individual divestments, so we need to go out and buy additional indices from MSCI to be able to calculate that. We think we'll have that number probably by early year-end, December 2023, and be able to then in the future break that out for people individually that want to see. I want to be clear, tobacco is by far the largest component of that because it's the biggest size stocks. Some of the other divestments were rather de minimis, in some cases 2 stocks. But there's been a lot of debate. Coal is probably the one divestment. You divested of U.S. coal, then non-U.S. coal almost a year later. That's probably the one that's probably the closest to break even or maybe turning a profit. And then we'll find out. And as we'll see, it's going to be, you can see on this chart, very time period specific. Sometimes those divestments have actually yielded a profit, sometimes and cumulatively a decline. So I'm going to jump through my CIO report pretty quick. Assets right now, it's been an interesting year. As I said in the semi-annual report, right now, June 30 really was about the low for the market. We thankfully stayed at 300 at June 30. We did broach that in late June. Amazingly, July and so far August, the market's rallied. We went all the way back up to 317. But now in the last 2 weeks of August, we've seen the market sell off significantly. They're off again today. I would not be surprised to see the markets go back and test those June 30 lows. That's been a constant debate on the radio and TV. And so we'll see, but we may go back and touch that 300 million mark or 300 billion mark or below as the market develops, whether it's a recession or not, as was discussed. Here are the allocation, looking at it instead of by asset class, but by characteristics, so equity growth. And as you mentioned, it really was the diversifying and the real assets inflation that really paid off last year. So having some diversification away from all being so strong in equity has really helped us. Here's a look over the 3-year period, and as you can see, the decline in the bright blue area, which is public equity, and the growth of really real estate and private equity, which adds to our diversification. And as you guys noted, RMS, which is in gray, I'd highlight the pink area, which is our inflation sensitive. Paul's done a really good job of growing that steadily and consistently. Inflation, I think, is going to be a real big debate at the in the look at the asset liability study. We've already had good discussions with the actuaries, David Lamoureux. It's going to be hard to forecast it going forward, but we wanted this longer snapshot. And keep in mind, this is just back to 2002. So 20 years is a long time, but we're going to go all the way back to the 80s. And you can see that so far for most of this century, it's been very low, but that just giant jump up that we've had this summer. Another interesting chart to look at and take some time with, I'll go pretty quick on it, but recessions are usually then preceded by big unemployment jumps. And so far, obviously, as you're well aware, employment's been incredibly strong. So will we have a recession or not? Bill, to your question about recessions, just take a second and look at the width of the gray bars, really inconsistent. And what we found, we were looking at bear markets, not just recessions. But when Stephen went back and looked at bear markets back beyond the 1950s, what we really found is there's not one that bears resemblance to the other. They're all unique. They're all caused in different ways, and their life is different. Recessions tend to be short, which you can see by the width of those bars. I mean, look at the size of 2008, and that was an entire year and a half. So they're often very short-lived, but and they're also, as you can see on the graph, very sporadic. It's hard to predict exactly when a recession will occur. So pretty much when I go up and look on the crow's nest at the horizon, most of the risks are very similar to what they have been. Big debate about the Federal Reserve and how much they will continue to raise rates. I put under there the question mark of the strong labor market, because you heard the tremendous employment numbers that were announced at the 1st of August. The next employment numbers come out this Friday, and I've noticed the White House is already starting to downplay it. So I think we'll see a revision back to what we got in August, and we'll see what we'll see what the August number comes back. We might see a revision of July. Global risks remain the same. Obviously, Russia, Ukraine has continued to sadly drag on and be a risk. I highlighted the China-Taiwan tensions. Those have gone up and gone down, although, you know, they're still flirting too close with aircraft and things with each other. And we've continued to put the global transition as a huge risk. So, and as I said earlier, the divestment cost and the special mandate policy are added attachments this month. Questions?
Any questions? Gail.
I just have one technical question on the asset allocations as we see private equities going down. What is that, just because we're then going into the private equity and real estate? I think you said that's where the shift happened. Or is some of it because as we move to more actively investing our public equities, like we spoke about this morning? The slide, just your bar chart on how public equities are going down. You said it's shifting into private equity and real estate, right? Is that right?
Correct.
And then
Private equity grew, it's a directly came out of public equity.
directly came out of.
Real estate is mostly public equity, but a little bit of fixed income, which has declined. And that's all a result of your, the 2018 asset allocation study. 18, 19?
19.
19.
19. Got it, okay. So when we see what we spoke about this morning as we transition to net zero and we have this, and I already forgot the fund we chose, the ACWI index?
ACWI low carbon.
Will that be reflected in public equity?
Yes.
It will still be, okay, so it wouldn't
when you
shift
look at that
out.
bright pink, bright pink, what did I say that? That's bright blue, right? Turquoise. Boy, I'm bad at my colors. 20% of that will now be in the low carbon index, and that will be increasing over time.
Great. Yeah, so that is really, when you look at it like that, when you see how much of that will be going into the low carbon index, it's really phenomenal. Thank you.
You bet.
No further questions?
No.
Any public comment on the reports given on the portfolio and the Chief Investment Officer's report? Any public comments? Hearing none. Thank you very much. We go to item number 6, approval of minutes of the July 7th, 2022 Investment Committee meeting.
Move.
It's been moved and second. All in favor, say aye. Aye. So, okay, then the next item is a review of information requests.
Thank you, Chair. I noted one for item 4B, a request that as we proceed with our ALM study, that staff consider modeling that would increase real estate exposure.
Go ahead, Harry.
Thank you, Mr. Chair. Yeah, if you could just hit my button.
Oh,
Thanks. There we go. So, yeah.
Would I love to?
Okay.
So I know that what we try to do when there's individual members who have requests for information, I want to be sure that it's just not Harry that's asking for the information and adding things to the staff's plate, because then we start piecemealing. So I want to be sure that there's enough support for the 2 information requests that I have. One would be to what extent, if at all, the decision to allocate 20% of the public index to the low carbon, how might that impact benchmarks? And if it does, we should kind of be updated as to the impact, positive, negative, or neutral, and if there's changes. So perhaps at an appropriate meeting, upcoming meeting, or communication, I don't know how it should be reported to us, but I think that's something we want to have visibility into, if that's okay. And then the second one,
Harry,
yes.
I don't know if I can.
Yes.
I don't know if I can ask that, but
Yeah, go ahead.
along the same lines, the impact, can it be impact to staff as well?
Well, that's, yeah.
Is that, can that be included in that, or is that implied?
It's implied in my question.
Okay, thank you.
Yeah.
Thank you.
Okay.
Anything else?
And then the second one has to do with the asset liability study, and I don't, forgive me if it's in the materials and I missed it. But I want to be sure that as we're looking at this in the spring, the role of emerging markets, EM, and will we look at models that are overweight EM, neutral EM, or exclusive, specifically thinking about where there's the lack of rule of law in countries where there might be the lack of rule of law and potential risks associated with that. And I have no idea what that is. And I know there's different views out there. And I, for one, would think it's a good item for us to at least look at some different modeling, overweight, underweight, or excluding a very important market.
Maybe we start with excluding
Maybe.
it first. Whether it's going to be included or excluded, then you can develop it from there.
Yeah.
Yeah, any objection to these requests on the board?
No.
Hearing none.
Thank you, Mr.
those are-
Chairman.
Thanks. Okay, the next item, and we will come to the end of the open meeting, is the draft agenda for the next meeting. Any additions or corrections, suggestions to the agenda? Hearing none, we will, does this take action? Yeah. Any public comment?
There is no one at the queue, and there is no one in the queue at this time.
All right, it's adopted. Well, thank you very much. It's been a long morning, but a very constructive one. And I want to thank staff again for their great work. And the performance last year was awesome when you consider the headwinds we had. And I also want to thank our very accomplished and helpful consultants today, both our Makita and our real estate fellas. Thanks. We're adjourned.
All right, we are calling the Benefits and Services Committee to order. Jasmine, can you take roll call for us, please?
Sure. Ms. Yamamoto?
Here.
Mr. Tang?
Here.
Ms. Bradford?
Here.
Chairperson Hendricks, you have a quorum.
Thank you, and I just wanted. Lynn Paquin is here as a, I want to say guest, but a non-committee attendee, so welcome, Lynn. Thank you. All right, and item number 1 is the approval of the committee agenda. Oh, may I read a brief statement? Oh, yeah, thank you so much, Jasmine, I appreciate it. It's late in the afternoon now, and I haven't had enough coffee today, so please, go ahead.
The CalSTRS board meetings are live web streamed, video archived, and available to the public on calstrs.com. Individuals who wish to address the board should wait for the 10-minute public comment period at the end of the agenda item the speaker wishes to address. For comments not pertaining to a specific agenda item, there will be an opportunity for additional statements at the end of the open session. Each speaker is allowed a maximum of 3 minutes to comment. However, if there is not enough time for each speaker to have 3 minutes, the timing will be at the discretion of the chair. To protect the privacy of speakers under the age of 18 who wish to address the board, only their first name and affiliated organization may be provided, but other personal identifying information, such as their last name, age, or school, may not be shared. Thank you.
Thanks, Jasmine. Keeping us on track. I appreciate that. Okay. And with that, I would entertain a motion for approval of the agenda.
So moved.
Second.
It's been moved and seconded twice. I like that. All those in favor say aye.
Aye.
Opposed? Abstentions? We have a approved agenda. Thank you, committee members. We're going to move to item 2, which is a review of our charter. So Bill, good afternoon.
Good afternoon. Bill Perez, Chief Benefits Officer. And we have for review and recommendation for approval 2 changes that were made to the charter based on recommendation in the May board meeting. The first is a change to the composition of the committee from all members to a minimum of 3 members as appointed by the chair of the committee. And then the second change is relative to the responsibilities of the board to be inclusive of oversight to ensure that the Benefits and Services Committee is aligned with the strategic plan in its oversight.
Thanks, Bill. This is an action item. Are there any questions from committee members?
So moved. Second.
No questions? No questions at all? Ken, Tag, you don't have any questions? Okay. Oh my goodness, this is going to be such a nice committee. Look at, no. Okay, so it's been moved and moved approval. Did you have a second? Thank you. It's been moved and seconded. All those in favor of approving the charter revision, say aye.
Aye.
All those opposed? Any abstentions? Great, our charter has been revised. I think the only comment I would make is just to kind of, I guess, state the obvious that in the past, the committee was a committee of the whole, partially, I will just say, for the intent of ensuring that the entire board is aware of the work that Benefits and Services does. I will just take a point of personal privilege as an active teacher that, to me, you know, the number one thing we do at CalSTRS is we pay out pensions to retired teachers. That's our job, right? We take money from active teachers and our paychecks, and we all, you know, gladly contribute. And then retirees such as Karen get to receive a CalSTRS pension in a timely manner. I do think there's so much to understand about the benefit structure. And to me, it's really the pillar of what we do. I know that we spend a lot of time on investments and other parts of the work that we do at CalSTRS, but I'm biased. I think Benefits and Services is the most important because it's what we do in terms of our mission and purpose. So that was the intent. And so I do think, Bill, we can come up with some creative ways, Ken, to figure out. I do think it's really important for our newest board members too, like Michael and others, to really understand how our benefit structure works, what a defined benefit pension is, the DBS, a lot of the other aspects of what we do in Benefits and Services. So I think we should figure out some creative ways to integrate that into the regular board meeting or things like that, so we make sure that the whole board is exposed to the important work that Benefits and Services does. Okay, with that? Okay. All right, thank you. And we're going to move to item 3, which is approval of the minutes from our May 4th meeting. I'll call on you, Karen. Do you have any edits?
Been done.
Okay.
Move adoption.
Okay, it's been moved
Second.
and seconded. All those in favor say aye.
Aye.
Opposed? All right, so we've adopted our minutes from May 4th. Thank you. All right. Moving to item 4, one of my favorite things, Tom Buffalo. I love hearing about our annual member survey. I like hearing how our members feel like we're performing in terms of responsiveness to their satisfaction with our organization and our services that we provide. So always look forward to hearing you and staffs kind of walking us through this. This is an information item. And again, if you have questions, feel free to queue in. So with that, I'll hand it over to you, Tom.
Thank you. Good afternoon, Madam Chair, members of the committee. My name is Tom Buffalo, and I'm the head of research at CalSTRS. And these are the results of the 2022 member survey. So the survey went out February 1st to March 8 of this year. We sent it out to about 110,000 members and received roughly 3,000 responses back. Here's some basic demographics on those who responded. Our youngest member responding was 22, our oldest was 98. That's in the first column there. If you look to the column there on the right, the service credit, that maximum, quick side note, acknowledgement to that member who had nearly 55 years of service in public education, so well done there. Some basic demographics on those who answer the survey, and of course, we're always very appreciative of our members who do respond to our research. And as evidenced here, we do receive a representative sample of our members here from a lot of different voices. So starting out, overall satisfaction with CalSTRS, we actually asked this question first on the survey to just kind of get that gut reaction from the member. We use a 7-point scale from dissatisfied all the way up to completely satisfied. And what we measure is what we refer to as our top 2 box, so those who answered satisfied and completely satisfied. So the question reads, overall, how satisfied are you with CalSTRS? And this year, 69% answered either satisfied or completely satisfied, which is consistent with prior years. Also took a deeper dive into what drives satisfaction with CalSTRS from an active perspective and from a retired perspective. And there's a lot of recurring themes here between the two groups. CalSTRS is an organization I can trust. CalSTRS cares about members like me. I know CalSTRS operates in my best interest. So trust and caring seems to be a common theme amongst both the active and the retired members when it comes to what is driving their overall satisfaction with CalSTRS. Also took a deeper dive into what is driving trust with CalSTRS among our active members. And there's 2 components here. It is one, the confidence that they have that they're going to have enough money to last throughout the retirement years, and then also their knowledge about CalSTRS benefits. So those 2 items were some of the key drivers around trust in CalSTRS. And what's interesting is that there is a little bit of a kind of a dichotomous relationship here. So this year, confidence, if you look at confident and then very confident, those, again, the top 2, actually went down this year. So their confidence in having enough money to live comfortably throughout the retirement went down, although their knowledge in CalSTRS benefits actually went up. So again, the survey went out in February. They were actually reflecting on some of their experiences in 2021, even though we refer to this as the 2022 survey. So throughout the year of 2021, based on, there's certainly a lot of, things going on in 2021, but it may have been reflected here in one, their confidence, but also maybe their pursuit of knowledge about CalSTRS. But either way, these 2 items contributed the most to their trust in CalSTRS, confidence and their knowledge about CalSTRS. We also measure what we refer to as engagement. Engagement is considered a sort of a step up from satisfaction. Engaged members or engaged customers are more likely to speak positively about an organization, promote an organization. There's 10 items here. We actually pull 4 of these items and then combine that with overall satisfaction. We calculate an engagement score for each member, and then we measure how much of our at least of the respondents are engaged with CalSTRS. So moving from left to right, you see trust there. CalSTRS cares about members like me. Each one of those asterisk items are the items that go into the engagement score that we calculate. So you can see along the top there, I feel confident. I know CalSTRS operates in my best interest. CalSTRS acts ethically. And then also CalSTRS sends communications relevant to my needs. So those 4 items plus overall satisfaction, we combine those, we take an average, and then that's what calculates our engagement, member engagement. So here's what that looks like. Essentially, it's on a 7-point scale. If your average score amongst those 4 items plus satisfaction is less than 2.5, we would refer to you as being disengaged. If your score is 2.5 up to 5.5, we would consider you neutral. And if your score is above 5.5, then you would be considered engaged based on our measurement here. And so 58% of CalSTRS members are engaged, and then overall engagement score for all members is 5.56, meaning that on the whole, on average, the membership is engaged with CalSTRS because they cleared that 5.5 threshold. Satisfaction with services, 70% this year. Again, similar measurement, 1 through 7 scale. And those who answered 6 and 7 are satisfied or completely satisfied is measured here. So 70%, actually, technically from a statistical perspective is unchanged from last year, but we're measured at 70% this year. But statistically the same as the 68% from last year based on the responses. Staff performance metrics, the top row is, we've added some questions around customer ease or member ease, if you will. So how easy was it for you to reach a CalSTRS staff member? So this is a new item, and you can see here that ease, 59% of members said that reaching a CalSTRS staff member was either easy or very easy. So that's a new measure. We'll continue this measure going into the future, and we'll have some time series data for this in the subsequent years. The bottom is something we've measured continuously over time, but again, very good scores for our staff and how they interact with our members. So courtesy, staff was knowledgeable, staff understands my questions or concerns, displayed a caring attitude, took the appropriate action, was knowledgeable about my questions or concerns. So very good scores here, all above 80%. So kudos to the staff for their approach with our members. Service performance metrics. Similar, we've added a kind of an ease question. How easy was it for you to get a resolution in your question or concern? And we have 64% either easy or very easy. And then our service performance, also very strong scores here. CalSTRS responds in a timely manner. Questions, answers to my questions were thorough, appropriate follow through, information provided was easy to understand, information from multiple sources was consistent, and it was easy to reach a representative when needed. So again, strong scores there. So again, kudos to the staff and the service that they provide to our members. Net Promoter Score, this is a newer measure. We started measuring this just a few years ago. We borrowed this from the private sector. So roughly 20-ish years ago, Bain, the consultancy, they developed this Net Promoter Score concept. You've actually encountered it in your various interactions with your service providers, but essentially the question goes, how likely are you to recommend our product or service to a friend or colleague? That's sort of the basics of the question. And this is on a 0 to 10 scale, where 0 is not at all likely, 10 is very likely. We adopted this methodology in full, so it's a little different from what we've calculated with some of our previous data here. But essentially, the way that it works is you take everyone who answers a 9 or a 10, who under Bain's methodology is referred to as a promoter. And a promoter is someone who would kind of seek value-creating behaviors for your organization, speak highly of your organization. So those 9s and those 10s are, then you take the 0s to the 6s, which are called detractors, and you subtract those from the 9s and the 10s, and you get this Net Promoter Score. Your score can be anywhere from -100 up to +100. So CalSTRS, of course, doesn't necessarily sort of compete in the marketplace in that same way. We alter the question just a little bit, and it reads, how likely are you to recommend or promote CalSTRS as a great organization? Same concept, 0 to 10. We wanted to try to get some applicability and some measurement to some types of benchmarks. So we had to alter the question a little bit, but we feel that it's, we can still use this relative to the way the question is worded in the private sector. But either way, overall Net Promoter Score for CalSTRS this year is 17. And to give some perspective on what that means, I have some benchmarks in the next slide here, but one common thing that we see is when members interact with us, their engagement goes up. Here we can see their Net Promoter Score goes up. It also goes up relative to age. So there's a couple of variables here. Interacted with CalSTRS versus did not interact. You can see kind of that orangish reddish is higher than the green. And then certainly as you move through kind of the various life cycles or segments in your life, your Net Promoter Score will also go up too. So you can see, for example, newly retired who interacted with us had a score of 54. And then those enjoying retirement, the distinction between the two groups, newly retired is anybody who's been retired within the last 5 years. Enjoying retirement is anybody who's been retired for 5 years or more. So those are, of course, some of the highest scores Net Promoter Score wise. And then just to put some of those scores in perspective here, this is CalSTRS overall score. You can see that there in the black, the 17 relative to, this is just somewhat of a kind of a random list of just different recognizable brands and companies that we found out there. So these are their net promoter scores. So this would be Apple going out to their customers and saying, how likely are you to recommend Apple to a friend or colleague? Same with Microsoft, Amazon, et cetera. So you can see how that 17 is relative to some of those other common brands. What's interesting is the lower half of this visual here, you've got JP Morgan, US Bank, Chase, Wells Fargo, some other financial institutions don't score as well, so to speak, relative to the 17 that CalSTRS scores. So I think it has to do with the trust that members have in CalSTRS, their overall satisfaction with services, and I think it's showing that CalSTRS is exceeding some of the other financial services companies out there. Back to the ease question. So how easy was retirement process overall? 71% of members said it was either easy or very easy. So again, that's a strong score given the nature of what we're here to do, which is to get them to retirement and hopefully make it an easy process to get them into retirement. Then there at the bottom, this is a question we've been running for a couple of years now. How satisfied are you with your retirement overall? Measured at 91% this year, which is consistent with the prior years. So ultimately, when you kind of package all of the data together, there's good evidence that CalSTRS, in pursuit of its mission to secure the financial future and sustain the trust of our members, we're well on that path, given what the members are telling us. With that, I'm happy to take any questions.
All right. Thank you, Tom. Questions from committee members? I can start us off if people want to take a few minutes. I think I always struggle a little bit with the numbers and kind of, because I think on I don't know what slide number it was, but the member engagement trend, when you have numbers like 57 and 58%, I don't know which slide it was back. Yeah, that one. So we're saying, is this saying that 58% member engagement is are we saying that's good? And or, because I heard you say the 5.56, which sounds like a statistical thing, right? Which I've taken stats, so I get it. So that means good. But I guess with the bar chart, 58 again is,
so the way you would read this is 58% of respondents scored either 5.5 or higher. So 58% are in that engaged range, whereas 40% are in that neutral range. Again, that's 2.5 up to 5.5. And then you have that tiny sliver down there, that 2% who would be considered disengaged, which is their average score is 2.5 or less. So
more helpful then. Okay, I got that. And then I think the other part I kind of struggle with in terms of, and this is your forte and not mine, but how we interpret when someone says it's difficult to retire. It's like emotionally, through CalSTRS, there's, a lot of ways you could interpret that question. So how do we ensure that we're asking a question in a way that is answering what we want them to answer, which is, how did CalSTRS, the organization, help you retire? Does that make sense?
Yeah, no, it does. We ask it very plainly, just we want them to respond in the way that just sort of natural to them. So it could include extenuating circumstances, things that we can't necessarily account for. You can't ask them that and then ask them a battery of 20 different questions after. Were you having a good day? Were you having a bad day? Was it, whatever actually, whatever sort of going on in their life, we try to do our best to balance kind of survey fatigue, just overwhelming with too many questions, with trying to gather enough information where we can extract a signal from that data. So, answer would be, we don't necessarily have that depth of information. It's just mostly try to ask the question very plainly and then just have them give us their kind of honest gut reaction to it.
Got it. Thanks, Tom. Karen.
Hi, thank you. Thank you, Tom. I was interested in the piece about the confidence in living comfortably throughout retirement for the active members only. So there wasn't a confident and very confident weren't that high. They weren't raised that high. So is it something that, I guess, retirement readiness or some of our other departments going after, like pension 2 or those kinds of things, was that, would that be something to follow up on this kind of a question if there are people that are not feeling that confident enough to feel comfortable in retirement?
You know, it's possible. We've seen the trend with the data tends to be that actives are less confident, and then when you're finally in retirement, you start becoming more confident. So I think it's just what's built into this concept is that uncertainty. You know, the farther you're away from retirement, the more that you're just thinking there's so many variables that I could be confronted with, you know, as I'm approaching retirement, and what'll happen 60 years from now and 70 years from now. But what we're seeing with the data is that when you do reach retirement, particularly when you have kind of that bedrock CalSTRS benefit behind you, that confidence goes up, significantly up. And so I think it's just more, you have more clarity about what's ahead of you. You understand your expenses better as you start retirement, as you're going through retirement. And so I think it's actually just sort of a natural progression of human psychology where it's just, there's so much uncertainty as you're younger, but then as you approach the actual event and then you start experiencing the actual event, your confidence goes up because you're like, all right, I know I can actually do this now.
Yes, so I guess it's important for the early, the mid, and the near retirement sectors, departments of CalSTRS to reach out or just make sure that that information is out there so that, you know, say like when you're nearing retirement, should you worry about paying off your mortgage or things like that, or just in preparation for retirement?
Mm-hmm. Yeah, I mean, we have courses, I guess, or webinars that help people understand some of the different financial avenues they can go to tackle some of those concerns of theirs. But yeah, I mean, as much as we supply, there's of course other information out there, but I just think it is kind of a function of getting there and then realizing, okay, it's not as scary as I thought. So.
Yeah.
Go ahead,
Just to comment a little bit further on this, when we look at the data and speak to this and look at it by the age group, it really is driven by age categories on individuals' understanding and confidence on what they're going to be retiring with. So if you look at it as it goes into the 60s, you know, late 50s, early 60s, when you're reaching retirement, then the confidence level goes up. And a lot of the times when we're following up on satisfaction in retirement, one of the questions is if you're not satisfied, why aren't you satisfied? And that's where we can really kind of drive an understanding of, have we provided the education that members need so that there is no guessing when they get to retirement, that they know exactly how much they're going to be getting, and that they understand and will be satisfied when they get there because they know what they're going to get. So that's where we really want to make sure that there is a connection with the information that we're giving them, and that they have the tools necessary to make those decisions when they get to that stage in life.
It's something that I actually think I would love for us, Tom, to like have a longitudinal study about that or something, because I know I just got my mid-career one in the mail, and I really do. I mean, I didn't get that 5 years ago. I think we've been talking about, you know, creating, you know, member communication that's really more tailored to kind of stage of life you're in. And so I know when I got that, I was like, oh yeah, like let me go through my checklist and let me, you know. So I do think, you know, you've heard me say this a million times, and trying to get the younger faculty, younger teachers, really starting to be more financially literate about, you know, retirement and savings in general. So I would be curious, you know, I'm assuming we keep all this data, so I would imagine in 5 years we could look back, because that's what I care about as a board member, is like, are the things that we're doing, you know, the member communication, you know, really impacting some of these, you know, questions. I want to build confidence in our members at any age of their development as teachers, right? So I think
even make sure they know CalSTRS is there for them, even though when we did some earlier videos, some of the teachers said, we don't know what CalSTRS is. So I think
I didn't know what CalSTRS was.
Yeah, it's really gone a lot. And I got my my updater.
Did you get a retiree?
Yes, I did.
See?
Yes, I did.
I know, tailor-made for you.
Yeah, it was in the last couple of days, so thank you.
Yeah.
Thank you, everybody. Thank you, staff.
Thanks, Karen. Ken, go ahead, and then I'll go to
Sure.
Mr. Nolan.
So I have a couple of comments and a couple of questions. So, I mean, I guess I'm looking at these numbers and our numbers that we sent out, like responses were 3,200 out of 110,000. That's less than 3%. So how can we engage our members even more? I know that you know, are there educations that we can set up, say for example, members can get a group together and we can send staff out there to put together a kind of like an education, a workshop for early career, mid-career, and late career educators to kind of understand, what it is that they need to retire. So are there stuff like that? And then I just received this recently. It's really helpful because it has a little formula that you can plug your numbers in.
Did you meet with a counselor?
No, this was sent to us. And
It came in the mail?
It came in the mail, yeah. So, and it says mid-career. So, I mean, it's and you can, there's a page in there where you can actually plug in your numbers and kind of figure out, approximately where you are going to retire without having to meet with a counselor, which, when you meet with a counselor, you have a more accurate number. Are there stuff that we can actually do to service our member better in that sense?
It's a great chance to plug all the workshops we've been working on
I think there are.
because this is something before you came, we've been working on that. So I'll let them toot their own horns, but I'm thinking about the different workshops for the different.
Yeah, I would let Bill speak to our outreach efforts and what we have and who they're designed for. Just a word about the response rate. So I know sometimes that 3%, somebody might be like, well, is that enough? And what does that actually mean? What it does is you sort of do a little bit of math with it, for example, but you end up calculating a margin of error. What kind of margin of error do we get? Despite the fact that we may have gotten 3% response from the 110,000 that we sent to, but roughly that number is still kind of strong enough, statistically strong enough to give ourselves a 2 to 3% margin of error. So what it tells us is that, and you saw the demographics of those who answered this survey. So we heard from a diverse set of voices, and then the amount of response that we get provides enough what's called statistical power to be able to measure differences, meaningful differences that may show up from the data perspective. So that in itself shouldn't really concern you as, it's actually okay, so to speak, that we received, that number because it does allow enough to, run different statistical tests. We test all of these numbers against prior years to try to see if there's a statistical difference between them. But there's enough there to help us find things if they're there.
Response rates are pretty low in general from most surveys, right? I don't
It's
want to
not
make
far
broad
off from
strokes.
what we've received in the past on this survey. But again, the volume that we send out and then, 3,000 responses in return, not to get too technical, but you measure sort of your variance and then you take the square root of your n, and that's what gives you your margin of error. And so that shrinks as your n grows. And so that's why, even with 3,000 responses, that's plenty of statistical power to measure.
Bill, did you want to talk a little bit about, kind of let Ken know about some of the educational opportunities?
Yes, as a matter of fact, and to Tom's point, marketing or surveying, statistical average is about 2 to 3% response rate. So we're pretty much spot on with what we would expect to see.
You just read it, but you're actually when you see the data on other surveying stats, you're like, oh, that's actually pretty good.
Yeah, and then Ken, to your point, in January, we're actually going to have an informational session that's going to touch upon, to a greater extent, the work that's being done by LiveStage in terms of workshops and group sessions by early, mid, and late career. We're also going to sort of add to that the touch points that we have within our customer service contact center as well. So that will be a January presentation. To give you an idea of the number, for this fiscal year, we actually had over 10,000 members in attendance in various workshops. And then through total touch points with members over 75,000, which is actually a record for us, in great part using technology to leverage reaching broader audiences. One of the things we're going to be experimenting with is simulcast, where we have live sessions that will also be available to those that can't make it to events. But we're going to be exploring much more on the member experience and how we can engage our members at an earlier point in time to start that supplemental savings towards retirement, and create the awareness that in most instances that pension is providing them with about a 55% replacement on their earnings when they're employed. So the earlier that we can get them saving on a supplemental vehicle, such as Pension 2, the more the power of that compounded deferred growth they have over time. But more to come in January on that. We are working to continuously enhance the number of offerings that we have to increase the awareness of our audience. And while it's different than the question that Tom was reviewing in terms of confidence, satisfaction with the process for retirement for fiscal year 21-22 was 86% in the top 2 category.
Thanks, Bill. And if you, I'm just kind of going on our website under members and the webinars, and because I always forget the titles, but there's one on like, let me just make sure I have it, Save for Your Future, which is kind of like a basic financial plan, planning, budgeting, plan for your future, protect your future. So, and those are kind of considered different life stages. There's one on Pension 2. So I think, and again, we've talked about this, that all of these, you guys keep growing and are so responsive to the board and our membership around kind of tailor making some of these educational pieces. And I think the question moving forward is going to be, Ken, I think, not only coming to the website and getting it, but could Ken, we know how old Ken is, are we going to send something to his cell phone to say, hey, Ken, here's a webinar that's, for your age group that we want you to attend, so that it's, more coming to you versus you having to go to the website to find the webinar or to have your union leader or something tell you about it. But it's something that we kind of, CalSTRS kind of initiates with our members, because I think that's really.
Yeah, I think I'm more asking from a perspective of as a union leader, hey, I want to set up a workshop for my fellow, colleagues, at my school district, how many do we need to, get a staff member to come out and put on a presentation? We do those. Right.
Yeah.
So then who do we call and where to, and that sort of information. So
yeah, call Bill. You know someone now, Ken.
Now that I know somebody,
you can help out all the teachers in the state.
No,
so
that's
good
true.
questions, Ken.
That's true.
And thanks for your patience, Leonard. I'm going to grab one more board member and then we'll go to you, Mr. Goldberg. Harry.
Thanks, Sharon.
Sure.
So I walked in the middle of the conversation, so it may have been asked and answered already. If it was, please forgive me. If it's in the materials and I missed it, please forgive me. But to Bill's comments and the inflection point of technology today, I think we have, and I'm sure you're aware of this, we have some great resources in some of our stakeholder groups and leaders within those stakeholder groups. And I wonder what the channels of communications are with them to ask them and get their input as to, hey, what would be the best day, what time? Do you have ideas for us to have more contact with our members, especially with the advances that we have, and I know you're aware of Zoom and the ability to convene people based on the number of touch points you had last year. But there's probably a couple of dozen key leaders that if we had open communications with them, they could probably help us better understand how we can meet with our members, when and where, and what the best way to do that. So if we're not doing that, I would encourage you to do so and make that a regular, channel of communication.
And I was going to say, I don't see if Diane, you are in the room. Thank you, Diane. Can you make a note of that for the stakeholder meeting coming up in a couple of weeks too? Because I think I want to make sure we emphasize that in that stakeholder meeting, just to kind of open up those lines of communication and make sure we do that. So thanks for that, Harry.
Sure.
Denise, let me get you in there. There we go.
So Harry, as it happens, you have a union leader right next to you who's been chatting with Bill a little bit, because one thing that has changed this year and that we were actually talking about was the late start, how high schools and middle schools now start an hour later. So we were talking about how maybe we could reach, what times would be good to reach those folks. So yes, there has been some discussion on different things, but there's always more welcome, I'm sure.
Thanks, Denise. All right. Mr. Goldberg, thank you for waiting so patiently.
My pleasure.
Yep.
Thank you, Madam Chairperson.
Sure.
There's a reason you guys are board members. You just asked a lot of the questions that I was going to bring up. So,
We were channeling you, Leonard.
so I just want to say, entering year number 35, I know I'm an outlier. I never seem to get one of the optional surveys, but I'd love to, and I'm hoping before the next 4 years I do get a
Write that
survey.
name
I'm
down,
charged up because I am a numbers person. I just wanted to say that on behalf of United Teachers Los Angeles and as the former retirement chair of CTA, we'd love to connect, and we have in the past with retirement readiness and these surveys, announcing it to our membership throughout the state of California. So let's get replugged back in, and I'd love to see, instead of a 3%, a much higher number, because I think a number of our members would like the opportunity to sound off if we said, hey, this isn't spam, this isn't junk, this is for real, coming from CalSTRS. Here's the date to be looking for this survey coming to your whichever email they have on file. The other question or comment I wanted to make, and I think it was brought up, retirement process. I lead the retirement pre-workshops in Los Angeles Unified, and I have to tell you, it's a little crazy. The CalSTRS portion of the retirement process, beautiful. But what we have to do to get our ongoing health benefits and other hoops that we need to jump through, that's where some of my members may be disgruntled. So I bring up that point again. How did the retirement process go for you? I think I would want to include our pronoun, CalSTRS. I think that's very important. And then finally, I'm checking off all these questions you guys already dealt with. I do want to say that in the past, we have, with retirement readiness, had workshops coming to LA Unified. We're delighted. I know that they also do them throughout the state when requested. So we just got to get the word out there again, get the party celebration of all this pre-retirement stuff happening. We got this teacher shortage. We had a lot of folks leave the profession. So now we got to re-educate people about what's happening. Thank you very much.
Thank you so much, Mr. Goldberg. I love UTLA. I was just communicating with a couple of your officers yesterday to support one of your board members. So I appreciate the feedback, and actually I'm going to take your comments and just, again, Diane, I think I'm going to be chairing the next stakeholder meeting on September 15th, correct? So stakeholders, we're going to be meeting here in Sacramento, and I think we'll make kind of a bullet point to have that conversation. I don't know about you guys, but I feel like COVID has just knocked me out of everything. I'm not exercising like I used to. I used to be running every day. So I feel like everything is off a little bit in terms of our routines. And so I'm so energized to be back with my brothers and sisters on the board and to see our colleagues in the audience. And I think we kind of need to reset that discipline and schedule again of member education. Like you, this is I help a lot of our members in my local, and I just can't, it's just like, I could do that as a full-time job. There's so many questions. Our district is really hard to retire from too. It's complicated. CalSTRS is great, but our districts are challenging, and you have to do it together. So anyway, so let's talk about that at the next stakeholder meeting. Just like reset that relationship, that conversation, so moving forward we can kind of work together, common goals. And then like you, Leonard, I think people don't know that you can, like any union leader, any can pick up the phone and say, hey, CalSTRS, we have 30 people here. And especially now with Zoom, we live in LA, so Glendale Service Center is right there. So I think we could have a conversation about just creative ways we can beef up our member education on retirement. So look forward to that conversation in a couple weeks. Thank you. Any other comments or questions from this? Tom, thank you so much for the hard work. Love the work that you and your team do to kind of keep us posted on how members feel. And thank you so much, Bill, for the work that you're doing on your team. So, and with that, let's move to a topic so appropriate for 422, which is subrogation, Raina. Love subrogation. I just learned about that. I'm taking a class on insurance. Can you believe that? I'm learning about insurance right now. and I kind of do know what subrogation means, but I'll let you tell the committee about this. So subrogations claims overview and welcome. I don't know if I know you, but I'm looking forward to, I don't know if you have, I don't have a name up there. Oh, I see it on here. So is it Suka? Suka, nice to meet you, welcome.
Nice to meet you as well.
Yes, so Reina, subrogation claims overview. Let's do it.
Yeah, thank you. Reina Minoya, Assistant General Counsel. Actually, Suka will be taking lead on this presentation, and so I will pass the ball to him.
Okay, thank you. Good afternoon, board members. Again, I'm Suka Chima. I'm the Disability Services Program Manager here at CalSTRS. So today, we're going to go over a subrogation claims overview that was previously requested by one of the committees. It's a brief information item to shed some light on what subrogation is and entails here at CalSTRS. So today we'll cover statutory authority. We'll cover the identification and referral process, and we will also cover a few data points. So during the presentation, we'll be happy to take questions, or you can wait until afterwards, either way.
We'll let you get through it first, that may make it easier, and then we'll hold questions till the end.
Okay.
Thanks.
Thank you. So okay, so what is subrogation? Subrogation is CalSTRS' right of recovery when a member's injury or death is caused by a third party. So essentially, the education code here aims to make CalSTRS whole when a third party is responsible for an injury or death that creates a CalSTRS benefit obligation, such as disability benefits that would be payable.
Like as an example of that, like a school district or something, or what would be an example of a third party?
An example, actually, I was going
sorry.
No,
See,
no
I said no questions, and then I just broke my own rule. Madam Chair.
No worries.
Madam Chair. Oh, well.
So if a member is injured by a third party and those same impairments entitle them to a CalSTRS disability benefit, CalSTRS may recover the actuarial value of the additional benefit payable. So an example of that would be, let's say a member is 45 years old and they get into a motor vehicle accident. And at that point, they're severely injured. They hire an attorney. They file a lawsuit against the other driver and the insurance company. And so at that point, the lawsuit is pending and ongoing. The member can no longer work. And as a result, that's where this CalSTRS disability benefits come in. They apply to CalSTRS. If they are approved for those benefits, then CalSTRS has the subrogation right to be able to file, to be a party to that lawsuit so that we can recover some of those monies. And as far as the actual value of additional benefit payable as listed there, what that entails is it's the difference between the higher disability benefit that would be provided to that 45-year-old and the lower service retirement benefit the same individual would have received at age 60 had they not been injured. Does that make sense?
It does make sense. Yeah.
50, sorry. And although survivor and family allowance benefits may be recoverable as well through this education code, the circumstances are highly unique and those are more rare to result in any applicable recoveries. And so there's not many referrals as a result. In regards to subrogation, CalSTRS can file a legal action. They can intervene in the claim itself or file a lien against any judgment that may be recovered by the member as a result of that third-party accident or action. Now, this is CalSTRS' high-level subrogation process flow. And so these are steps. So identify step one is where we identify there's a potential subrogation for a case. Now, it could be identified when a member or an attorney calls CalSTRS and asks about disability benefits and mentions they were in an accident or whatever the third-party claim is for. It could be during a benefits planning session with retirement readiness, they mention it at that point. It could be once the disability application comes in, there's a section on there for subrogation where your injury is caused by a third party, and so they could complete it on there. It could be through phone conversations with the assigned analyst after they apply for disability benefits. It could be through the medical records that my program reviews, and it could show up in there. So there, as you can see, there could be a variety of different ways. It could be through Google searches, news reports. It could even be through when we receive third-party subpoenas for that case, or through Public Records Act requests and the like. So there's a variety of different ways we can discover subrogation. Could be a potential on a case. Once identified that there is a subrogation potential, then what our group does is the assigned analyst will contact the member and or their legal representative, and we'll send a subrogation notification letter to put them on notice that we have subrogation rights for that case. So moving on to step 2, upon approval, if a member's disability application ends up being approved, then at that point, if staff has identified there's a subrogation potential, then the analyst will put together a subrogation packet, which is basically information for our legal services department to pursue that, to be a party to that lawsuit. And then step 3, the case is then referred to legal.
Yeah, so at that point, once the legal office receives the subrogation referral, we'll take several steps to determine what our next course of action might be. So one of the first things that we do is to confirm the subrogation potential. And what that entails is looking at whether or not there is an injury that was allegedly caused by a third party for which a disability retirement or a family allowance was approved. And if we confirm that, then we look at the actuarial calculation that Suka was discussing earlier. And so what that is an actuarial calculation that's taking a snapshot in time. It's reduced to present value. And we look at the higher disability retirement benefits that are now payable as a result of the accident versus what the member would have been entitled to had they not been injured and they had applied for service retirement when they were eligible. And so, if we take Suka's example earlier of the member who was involved in that car accident, we'll ask the actuaries to make that calculation. And let's say their disability retirement actuarially is calculated at $1.5 million present value. They'll also do the calculation for their service retirement benefit. And let's say that that's $1.2 million instead. So that $300,000 difference, that's that actuarial calculation, the subrogation amount that CalSTRS is entitled to. Because if you look at it, we're essentially saying, had this third party not run into our member in this car accident, we would have only been paying the member 1.2. But because they were at fault and they caused our member these injuries, which entitled them to these enhanced higher benefits, the fund really shouldn't be paying out that extra difference. And so the law allows us to be able to go after the third party for that subrogation amount. So during this course, as we're going through the actual calculations, we're also evaluating what the status of that third party action is. So depending on when we get notified or how we come to identify a subrogation potential, it could be that the member is yet to file a lawsuit. Maybe they've just, they were recently injured, they're thinking about filing a claim, and so it's a little premature in terms of a lawsuit actually pending, but we'll keep an eye on it. It could be that the member's lawsuit is already pending, and so we'll look to see if there's a lawsuit that's filed and what the status is. And at times, sometimes that lawsuit will already have been resolved. So depending on what the status of that third-party lawsuit is, that's going to change the course of our action. And so depending on what that is, we will evaluate what the recoverability steps are. And it's always done on a case-by-case basis. There's always different statuses in terms of the underlying case. And so depending on that, we will reach out to the member or their attorney, potentially the third parties as well. And all throughout this process, we're providing the relevant parties with additional notification about our subrogation rights. So when Disability Services initially identifies a subrogation potential, they will notify the member about this right if they are going to be approved for disability retirement. Again, all the publications and documents that Suka talked about also provide the member that notification about the subrogation potential. But once the case comes to our department, we provide additional notification as well so that there's no surprises to the member. And at that point in time, we will pursue the action and see what the recovery for CalSTRS would be in each of those cases.
Okay, this slide here shows the disability benefit subrogation referrals over the last 5 calendar years. And over that time frame, there's been 1,939 disability applications that were approved over those 5 years. Out of those, subrogation referrals comprise, there's 26 total, so that comprises 1.34% of cases are referred. So it's about 5 a year roughly. And out of those, there's been full or partial recovery on 19 of those 26 referrals. So in regards to CalSTRS subrogation process, it helps basically to keep the fund whole when a third party is responsible and results in the member applying here for benefits that would not otherwise have been paid out. And the subrogation education code is applicable to both disability and survivor benefits. Although survivor benefits is, again, very rare. That's why we didn't include the statistics here. And the 1.34%, there's, again, very few claims in regards to subrogation. Is a very small component of the disability services overall program. There is a substantial recovery when we are able to recover that actuarial calculation on each case.
Great. Got a couple questions. Did you want to add something, Brian, before we go to questions?
Recovery over the last 5 years has been approximately $1.7 million from those 19 different referrals.
Out of 19 referrals?
Right.
Yeah, interesting. Let me just clarify. It says 17 to 21. That seems like 4 years. Am I calculating that right? Is that 4 years?
It's 17, 18, 19, 20, 21.
It's 5? Gosh, too much math. Too much math today, you guys.
It's late.
Who's putting these board materials down? Gosh, I'm tired. I know. Thank you.
That's a Karen question.
No, I mean, no. Well, okay, anyway. Karen, speaking of Karen questions,
Okay.
Go ahead, Karen.
All right. So I was looking at the process flow, and then you're talking about the identity, the process of trying to decide if it's going to be, if it's going to go full to the end, basically. But where's the member through all of this? Does the member communicate with CalSTRS, or is it only the at fault party that does that? Or how does that work? You know, if it was me that was in the accident, you know, how do I know what's going on? Or is my attorney helping me communicate with CalSTRS, or how does that work?
All of the above. Yes, as Suka was mentioning, during the disability retirement application process, the evaluation process, the caseworker will communicate with the member throughout identifying a potential subrogation, informing them that if their disability retirement is approved, that CalSTRS may be seeking a recovery from the third party for a portion of it. And certainly once it comes to our office, we communicate with the member, or if they're represented by legal counsel, their attorney, as well as the third parties who they've identified as having caused those injuries. And so we are in constant communication with them throughout the process from both our teams.
Okay. So once I, as the injured member, settle with the person that's driving the other car that caused the accident, then that's my communication with that. And so then I guess I just want to make sure that there's a loop and that the member is always notified and keeps apprised of any communications or any obligations that person needs to do.
Yeah, you want to take that?
Right. I believe we do a pretty good job of communicating from the beginning, even before they apply for disability benefits. It's in our publications. It's when they apply, it's in the actual application as well, notifying them of our subrogation rights. Once the disability application is received and submitted by the member, we also notify them through another letter providing our subrogation rights as well. And so it continues. We probably at least half a dozen times or more in writing communicate that we have subrogation rights in our process. And this is even before it's referred to legal services for them to take over. And so as an example of this, many years ago, I had my deposition taken in regards to a subrogation case, and I had to testify of all the different ways that we notify members and their attorneys of our subrogation, our rights. And I think it could be even up to a dozen times that we notify them. So the communication is definitely there.
Okay, but as far as subrogation, then the only entity that receives any rewards or money from that would be CalSTRS, right? And the member has no, is not included in that, I guess, capture of any kind of any additional monies?
Yeah, so that example that I gave you where we looked at the 1.5 disability retirement versus the 1.2 service retirement, that difference of 300,000 comes to CalSTRS.
Right.
But the member is still entitled to a lifetime disability retirement benefit from CalSTRS. Plus, if they resolve that third-party action, that lawsuit, and there's either a judgment or a settlement, that money goes to them.
Right, okay. But the subrogation claim, or I guess I'm not, is it?
Think of it as two different things.
Yeah, it's two different things,
Yeah.
right? So
The
then.
person gets in an accident, they deal with the
Yeah,
person.
and then the
there's-
subrogation part is the CalSTRS. That's why CalSTRS gets to do that, is because it's a subrogation third-party injury claim or lawsuit.
Yeah, subrogation
understanding that
basically means you step into the shoes of someone else. You enforce a right that belongs to someone else. And so that's essentially what CalSTRS is doing. We're stepping into the shoes of the member, along with the member essentially, to say, hey, you injured me, i.e. the member, you need to provide us some reimbursement rights because what you did caused us to pay more money.
Right, okay.
And so that difference that we're talking about, that subrogation amount, goes back into the fund because essentially we're holding the third party accountable for the additional benefits, the enhanced benefits, if you will, that we're being caused to pay.
Okay, thank you. Thank you, Sharon.
Yeah, no, that's great. Okay. By the way, I was looking at a fiscal year, 17, 18, 18, 19. I just want to clarify, because that's how my brain works, because I was a treasurer for a long time. Anyway, no, I think that's a good question, Karen. I think this is really interesting. I'm actually a little surprised at that number being so low. So I just assumed a lot of our disability retirements were due to, so it sounds like a lot of either they're not reported or it doesn't come through subrogation, or is it right to think that then most of our disability retirements don't involve like a third party, basically? Is that a correct way of thinking about it?
Yes, that'd be correct.
Huh.
Earlier, I detailed all the different ways we can find out if there is a third-party lawsuit or claim filed, and we just don't find that there's any more than that. I mean, we look, we certainly do our part as a program in searching Google to whatever other resources that we do have to try to find out.
So it's mostly medical,
Yeah,
just
because, well,
in general?
Would entail accidents generally.
Say that again, Cassandra? The first part?
Subrogation would generally
Right.
entail accidents,
Right.
scenarios resulting in disability. But disability is attributed to a lot of other things, like medical conditions.
That's what I'm saying, though.
Yeah.
is What I'm saying is the bulk of our disability tends to be medical. I got cancer and I can't teach anymore. So I guess I live in Los Angeles where there's a lot of accidents all the time. I just was surprised that the subrogation, that's such a low number. 1.34 seems low, but.
Yeah, I was surprised by the percentage.
Yeah.
But it's good. Yeah, it's not, disability is not good at all, but yeah, so, good. Any other questions from committee members?
No, it's very.
Subrogation, what a good way to end it. It is
I like that
interesting.
word.
I am a nerd about these things. I love learning.
Word.
Yes, and it's so nice to meet you, Suka. Thank you for the
for your time.
presentation. Thank you so much, Rena. Appreciate that.
Thank you.
Okay, any information requests, Jasmine, that you heard?
Nothing specific, but just to check on item 2, you had mentioned that you wanted to highlight the work of Benefits and Services Committee for the entire board. Not sure if that was an information request or just.
It's a good thing for you to remind me as vice chair of the board, and I'll remind Mr. Chair that we want to keep that as in top of mind for opportunities to educate the entire board on some of the work that Benefits and Services do. So I think there'll be opportunities for us to weave it through the regular board meeting. So thank you for that, Jasmine. The draft agenda. So when I met with my co-chair Ken Tang and Bill, we chatted a little bit about the draft agenda, which is item 7. Bill, do you want to call our attention to anything specific? I think there's an interesting item in there for our discussion. So come on up one last time.
There'll be 3 informational items. One of the ones was the one I alluded to just a little bit earlier, which is focusing on the customer experience and our engagement with members, both now and into the future. The into the future is leveraging or implying the utilization of technology amongst other tools. And then we'll also have 2 other informational items. One is the supplemental information on the triennial health benefit study that was requested, as well as the lump sum death benefit analysis that'll be presented by Tom and David Lamoureux.
Great. Good. So we've got plenty on the agenda. Obviously, we craft agendas with the input of the committee. So always welcome when it's within the work plan. If committee members have questions, concerns about the agenda, let us know. Otherwise, we will accept the draft agenda and get ready for the next meeting in January. So thank you, Val. Appreciate that. Thank you, Ken, for your input on that. With that, I will leave it to opportunities for statements from the public. Do we have any members of the public who've stuck around with us this long and our Benefits and Services groupies who want to share questions? With that, we will adjourn Benefits and Services. And we are starting the regular board meeting at what time tomorrow, Cassandra? Is it 9? Okay, so 9 o'clock tomorrow morning, regular board meeting, open session. So for those members of the public and teachers, have a restful good evening, and we'll see you right here, 9 a.m. tomorrow morning. Thanks, everyone.